Welcome to the first Traders Webinar exclusive webinar for the year. And we're going to be doing Where Will 2021 Take Your Trading? So please check out our website, tradersexclusive.com, where we regularly post articles and video clips and valuable trading tips and techniques. And this is also where you're going to find a recording of today's webinar, and I'll put up a screen for that. And before we get started, we do our quick disclaimer. Our presenters today are Chris Vermeulen, Eusebio Nanni, Barry Burns, and Marina Villatoro, and it's going to be a good one, so hold on and take notes. So with our disclaimer, you should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations are subject to change at any time. Past performance is not necessarily indicative of future results. And first off for today, please take notes and write your questions down with a little bit of context, because I don't like putting the questions in while the presenter is talking, and there's a very good chance that they're going to answer your question while they're speaking. So hold your questions, but write them down. We definitely want you to ask. I'm going to introduce our first speaker, Chris Vermeulen of the technicaltraders.com, with how to own the hottest stocks before everyone else. Chris is the founder and chief market strategist of the technicaltraders.com and an internationally recognized technical analyst, trader, and author of the acclaimed Technical Trading Mastery. He's semi-retired in his mid-20s and has been teaching others technical analysis and his strategies on how to beat the markets ever since. Chris is a frequent guest on Yahoo Finance, TD Ameritrade TV, Cheddar TV, Kitco News, and many other financial portals. Chris is teaching his 100% mechanical trading system, BAN Trader, to help traders eliminate emotions as well as identify the best asset now to trade and own. So let me just make him our presenter and make sure that he can speak, because I'm pretty good with the mutes. Are you with us, Chris?
Hey, Sherry. Yep. Can you guys hear me?
Hey, I can hear you. So I'm going to make you the presenter now. And right. Everybody, you're going to like this, so hold on.
All right. You can probably see a chart there, a screen, I take it.
I do. I see it.
All right, guys. My name is Chris Vermeulen. I'm from the technicaltraders.com, and today I've got a pretty exciting, it's not just a normal webinar. This is a 2.5-hour course that I usually teach, and I'm breaking it down, obviously, in under 45 minutes. So we've got some pretty exciting stuff. I'm going to show you how to own the hottest stocks and sectors before everyone else does. And when people are talking about it in the news, you're going to have that big perma smile when you've been holding it and it's up 30, 40, 50%. And I'm going to show you exactly how to do that. And the reality is, if you don't trade this strategy, you're going to be left behind, and you're going to find out exactly why it's tough to beat the strategy I'm about to teach you. So I use a strategy called BAN, stands for Best Asset Now, and at any given time, we can find the best stocks and sectors to trade. So just be involved in the webinar, focus on it. I'm going to be going very quickly because I want to cover a lot. I want to teach you this strategy, but keep in mind at the end of this webinar, I've got a video course and a checklist. So if you can't keep up with how quick I'm going, bear with me, and you'll get everything that you can follow after this webinar. So a little bit about myself. I'm a very conservative trader. You're going to see that everything I do makes logical sense, and I don't apply leverage to anything. I'm giving you a rock solid strategy that you can apply leverage on as we go. So let's jump into the slides, and we'll kick things off here and jump right into it. Okay. So quick disclaimer, I know Sherry just did it, but I better do it anyway. Access to this webinar is for educational purposes and informational purpose only. We provide educational services that are meant to teach you the risks and rewards of trading and are not implying or guaranteeing any profits. Past results are not necessarily indicative of future performance. Trading securities and options involves risks, so do not trade with money that you cannot afford to lose and consult a licensed broker and financial advisor before placing any trades to ensure it is suitable for your personal circumstances. Guys, I am not a registered broker or advisor in any way, nor is my company. So if you've got any detail, if you want to get into more details with the disclaimer, you can follow our disclaimer link at the bottom here. Now, the brutal reality is if you're a short-term trader, doesn't matter anything below an investor, 95% of you are going to fail. And that's the brutal truth. I know a lot of people probably here have been trading for 5, 10, 20 years and probably haven't become highly successful, as successful as you originally thought you could be from the markets. And that's because this market is very efficient at taking your money. And so a very small group of people, only 5% of people actually make a fortune from the stock market. And it's because 5% are pretty much taking the money of the 95%. And what I'm going to show you today is a strategy that almost every professional trader, hedge fund, money manager uses, and it puts the odds dramatically in your favor. You're going to see that. So we're going to turn the tables so that 95% of you in this webinar, if you listen, follow the course and the checklist when we're finished this course, you can all become that successful 5%, and we can be taking money from everyone else in this market. Now, what I'm going to teach you here doesn't require any proprietary trading tools, nothing like that. You're going to be able to walk away from this webinar with everything you need to find the trades, manage them properly, and absolutely crush the markets. And this is what our goal is. The band strategy trades, these ETFs, we want to be holding these ones. When the stock market's rising 5 or 7%, we want to see our ETFs performing, 4 or 5 times that, 20, 25%. And I'm going to show you how to do this without applying any leverage to these sectors. And that's the key. A lot of people like to trade the 2, 3 times ETFs. They like to use options to show the results, but I show killer results using just a rock solid strategy that's very conservative with low drawdowns. And the cool thing is you'll be able to take this strategy, and if you're in love with leveraged ETFs and options, you can absolutely amplify this to the whole next level, and the results are almost unbelievable when you actually graph them. But if you want to trade options, this is our recent triggers, gives you an idea of the type of trade setups you're going to learn. When we find a trade setup, you get the signal after the market closes. So you have all night and the next day to enter at the opening bell, which is really nice. You can do it as a part-time trader, super easy to follow. More or less, if you were to get into a trade, you can see how this MJ ETF, which is the marijuana ETF, recently had a trigger, and it rallied with a simple call option, 226%. It did this in 7 days. And you're going to notice we're going to be shooting for 7%, 15%, and 20% gains on these trades. And they usually happen within a few days or even just a couple of weeks. So if you apply leverage, you definitely get some real power behind it there because you don't have too much time decay. So what I'm going to teach you here is a winning trading strategy. Everyone needs one. You're going to find out how to find these profitable trade setups, and then I'm going to walk you through how to manage the risk and these positions, because that is actually one of the most critical parts and where most people fail. So at the end of this webinar, I'm going to give you a quick offer, a special offer, but regardless if you take me up on that or not, this webinar is a full-on course. Get your pen and paper out and get ready to actually learn how to find these trade setups. And again, I mentioned at the end of the course, I'm going to give you the course and the checklist in a video format so you can follow this with fine detail. The reality is most people right now in the world are struggling with their life and business and trading in general. You're going to walk away from this webinar with a solid game plan. You're going to have a strategy. You're going to feel like, your future is bright. It's a pretty exciting, eye-opening experience. You're going to be looking at the stock market and probably the way you've been trading in a whole new light, and it's going to impact everything going forward, more or less for the better. So a little bit about myself. I'm Chris Vermeulen, born in Canada, just north of Toronto. I live on the Great Lakes, and I started paper trading in 1997 in high school. I loved it. I started trading real money through college, ended up making enough to pay for my last year of college, tuition, and residence. And that's when I actually started teaching other people to trade. My roommates, their friends, was in the dorm room. And so I've been teaching others to trade from an early age. I grew up doing this. This was my video game stock market trading. And so I've been trading and teaching for well over 20 years already. And a little bit about my background. I came from a family where both my parents had their own jobs, their own businesses. They're entrepreneurs. They work 60, 80 plus hours a week. All they did was work. And unfortunately, I had to live through a bankruptcy and watch my parents lose absolutely everything. In Canada, when you go bankrupt, you're allowed to keep your clothes and some furniture. The rest gets taken away. So I had to live through that. Tough on relationships, very uncomfortable, embarrassing for everyone involved. And that is something that I do not want anyone to go through. And living and going through that, now that I know how to make money from the market, I just want to give back and show people this strategy. And that's one of the main reasons for teaching this today. So here's my family, my wife, Kristen, Ben, Mirabel, myself. We love to travel the world. It's my son and I going out in our backyard to go surfing, playing the waves. We love to ski. My daughter's got a horse, she competes. And we just live life, and we have a lot of fun with our family and friends. And it's just an absolute great lifestyle that this trading strategy in the financial markets can provide if you can get a handle on them. So I'm the author of Technical Trading Mastery, 7 Steps to Win with Logic. Everything I do here makes logical sense. There's no real mind-bending strategy. You're going to see that. I've been in a lot of different media, provide a lot of content to sites. We've got traders from 82 different countries who use the strategies, and everything I cover from long-term investment signals all the way down to swing trading, ETFs like I'm showing you today, all the way down to stock trading and options trading as well. So cover the whole gauntlet, all based on pure technical analysis. The only way we make money, guys, as a trader is if price goes in our favor. So I throw all news and fundamentals out the window, and I just follow price. So this trading strategy I am about to teach you is based on the relative strength strategy. Now, don't get this confused with the relative strength index, known as the RSI indicator. The RSI compares a securities price to itself historically. So it's pretty much garbage in terms of what we're using for this strategy. This relative strength strategy is comparing one asset class or group of stocks to all the other groups of stocks. So we're constantly looking for the best asset now, which is why I came up with the band trading strategy. So again, no proprietary tools. You're going to be able to do all this with a public website. I'm going to show you step by step. But the first key thing here every successful trader needs is you need a trading strategy. It's the #1 most important thing. And if you've got a successful trading strategy that's got rules and you can follow those rules, you are light years ahead of everyone else. Now, by having a strategy, it's going to reduce risk dramatically, and you're going to find it frees up a ton of time. And this is really going to stand out later on this presentation of just how important time is. It's really the most important or the most valuable asset we have. And this strategy is built to give you the lifestyle, more or less, and not have to overtrade to try to make your money. And of course, by having a strategy, it's going to create account stability because you're going to have consistent trades. You're going to have reduced drawdowns because we've got rules in place. You're not going to be holding through some market crash of 20, 30, 40% or anything like that. And the reality is 70% of all volume traded on the stock market is traded from trading systems. And that's because professional traders, they get a trading strategy, just like I'm teaching you today. They automate it and they let the computers do all the work. There's no need. Human error is a huge part of trading losses. If you've been trading for any length of time, you know how easy it is to put on the wrong positions and all those things. Now, this company, Cambria Investments, they manage over $1 billion in assets. And they did this research report saying that relative strength outperforms the buy and hold strategy 70% of the time. And what these guys are saying more or less is if you buy the leading sectors, the top performing sectors or stocks, you're going to beat the average buy and hold. You're going to beat the stock market index 70% of the time. So this is the foundation of what this trading strategy is built on. We've got a 70% chance of outperforming everyone else right out of the gate. Now, imagine if we improve this strategy with a little bit of market timing, and then we throw in a little bit of position management. I mean, this is the tip of the iceberg. This is pretty exciting stuff. This other company did a research report, AQR. They say that leading stocks outperform 12 months after they lose leadership. Meaning, if we get into the leading stocks, and then say next week some other sector just goes on fire and takes off and actually starts outperforming the sectors that we're in, well, it doesn't matter too much because 12 months later, the once leading sectors are still performing very well. The center line here is the index. It's the buy and hold strategy, and we're still going to be outperforming it. So not only are we going to outperform 70% of the time, but even if we're a little bit off and something else takes the lead, we're still going to outperform fairly dramatically. And if you were to do the opposite end of the spectrum, this company confirms that if you buy the laggards, the ones that are trying to put in a bottom you think are oversold, 12 months later, they're generally lower in price. This is why you do not want to go picking bottoms and picking the one that hasn't run yet because it's garbage in terms of where we can trade the cream of the crop, or you can mess around with this and really struggle. You're going to see how explosive these moves are when you get into them and how it's almost like a balloon with helium. They just want to keep going up and up, even on the stock market days when they're selling off or chopping around. Again, this is the most widely researched trading strategy. That's the relative strength. There's hundreds of academics, trading firms that have confirmed it. They all come to the same conclusion. If you own the leaders, you're going to outperform the rest of the market. And that's why you see these sectors and these top stocks just keep going and going. That's where the money's flowing. The big money knows that, and they just keep dumping their money in there. Now, this is me scrolling through 165 sectors and industries. We're going to be trading these. Now, we're going to be trading those using ETFs. So think of this whole chart, this box here, as the energy sector. And within that energy sector, there's a whole bunch of other smaller energy sector groups. So the best performing in 2020 was the clean energy sector, 162% up. One of the worst performing was the OIH, the oil holders, minus 37%. So instead of just trading an index or the general sector of energy, we dissect it and we find where these real winners are. And you can see there's almost a 200% percentage point difference in these plays. Now, it's a lot easier to get into a trade and manage a position that's moving like this, a series of higher lows and higher highs, than it is to do something with spikes and drops and just totally underperforming. And what I'm going to do, it's like that analogy. Give a man a fish and you fed him for a day. Teach a man to fish and you fed him for a lifetime. And that's what I'm going to show you. I'm going to show you how to find these. You're going to start to become very confident, comfortable. You're going to be excited every time there's a new stock market buy signal to get into these leading sectors. And you're going to see how it can make you, financially independent. You can start to rely on the stock market in a very controlled manner. So this is just a quick reference. If you were to trade something, this strategy, going back to 2007 in like an IRA account or a tax-free saving account, whatever that is in your country or where you are, this is the type of results you can get by just moving into the top 3 sector ETFs every time the stock market gives a new buy signal. It works in bear markets. This is no leverage, guys. This is absolutely no leverage. This is just buying a straight up basic ETF. So you can see the SP 500 is up 145. I think now it's up about 155, and this is up a little bit higher as well. But this strategy, if you follow these and you buy the leaders on every buy signal, which I'm going to show you how to identify those buy signals, we win around 75% of the trades, which is huge. The average holding period for these trades is 39 days, which is roughly 2 months because there's 20 trading days in a month. And it's got about a just over 17% drawdown versus the SP 500, which is a 53% drawdown. NASDAQ was, I think, an 83% drawdown back in 2002 or something like that. Just terrible drawdowns. And we can avoid all of that with a strategy focusing on these leaders. So I've been trading the band strategy myself for years. I've been constantly refining it, and I finally found a way to improve it to a few notches better. And so I'm really excited. That's why I want to show you there's some really easy ways to find these trades, and it doesn't require anything complicated to do that. And the trading account size that you might have, it doesn't matter what you trade. If you've got a couple $1,000s, it'll work. If you've got millions of dollars, I know guys trading huge money with this strategy. It doesn't matter. It works all along. Okay, so let's get into this trading strategy. I know I'm flying along. This is a lot of information I gotta cram in here, but let's keep moving. So you need to know step number one, make your notes here. Step number one, we need to know the stock market direction. It has to be favorable for us to get into these momentum stocks. Pull up the SP 500 chart. It's gotta be a daily chart. Throw the 50-day simple moving average onto it. If price is above the 50-day moving average and the 50-day moving average is sloping up, the market is in an uptrend. It's favorable for us to get into these leading sectors. When the market closes below the 50-day moving average or the 50-day moving average is sloping down, or our position gets stopped out from some type of trailing stop, then you get out and you do nothing during this time. Not for this strategy. You avoid the market crash, and eventually you're going to get in when the dust settles and price is above the 50-day and the 50-day is sloping up. And I'm going to talk about quickly how this strategy performs and reacts in a choppy market like this. So step number two, this is where we go to barchart.com, grab the menu bar and go to ETFs and then click percent change. It's going to bring up this page. There's these two fields. Quickly grab the field on the right. You're going to click the down arrow here, and then you're going to select performance. It's going to pull up everything based on a percentage performance from best to worst. And then you got to go to this other field here and grab select 5-day. So we want to know the top performing sectors over the last 5 days. You're going to copy and paste this table, throw it into Excel. And then you're going to go up to this chart and select monthly. You're going to copy and paste it, put it in Excel. You're going to do the same for the 3-month, 6-month, and 52-week. And again, this is all explained in the video course I'm going to give you right at the end of this webinar, so just hold tight if you can't keep up. Now, once you've got all these, you're going to sort through all of them in Excel, and you're going to find out which ones ended up on every one of those searches. So they're top performing on this scan. Oops, let me just go back. Top performing on this scan in all those time frames, and you're going to put them into a table. I'll just skip that here. You're going to end up coming up with your top selection. This is just a rough one I just threw together, but these actually ended up being real trades, which is crazy. So the top performing one, the one that ranked the highest on most of those time frames, is going to be our number one pick. We're never going to challenge that. TAN, huge sector last year, up 239%. That's our number one ETF that we're going to trade when the SP 500 closes above the 50-day for the first time. That's a new major signal. Now we've got to make sure that we don't put too many eggs or more than one egg in the same basket. So if we look at the next one, it says clean energy ETF. Well, if you read between the lines, solar is clean energy. So you do have to read between the lines a little bit for things. So we're going to scratch anything that is clean energy. Clean energy, clean energy, clean energy, some environment, something, energy. We don't want any more energy. We're done with that. The next one is a unique one, looks different, ARC Innovation. You click on the link, you pull it up, you click on this symbol, you pull it up, you compare the two daily charts. If they look the same, they sell off and rally on the same days, big patterns, very similar, then you want to go a little deeper. Go on the holdings link that you'll find on that page for each of those and compare their top 10 holdings. If they've got the same top holdings, a couple, 1, 2, 3, or 4, you really don't want to be owning ARC because it's really a duplicate play. You don't want duplication here. We want diversification. So we skip all those. Eventually we come down and we go, hey, internet. That has nothing to do with solar or energy. Perfect, there's number 2. And then the last one here is HAIL, smart mobility. This is the EV, electrical vehicle market. That's our number 3 play. So if we take a look, this was that chart I showed you. This was TAN, which is the solar, ARC, which is internet, and then HAIL, the EV. You can see how the SP 500 NASDAQ rallied 5 to 7. These things just took off. So the nice thing about this strategy that I'm teaching you is it's a mechanical trading strategy. You have to have at least one because it's your foundation of trading. And once you have a mechanical strategy, that means it's repeatable. You've got to, you're going to own the top 3 sector ETFs. So you're owning the best sectors at any given time, which is almost priceless. Plus, you've got complete diversification between three different sectors. And I'll tell you, when the markets are trading down or sideways and you see all your trades, your portfolio ripping to the upside, I mean, you can't even sit at your desk. It's pretty darn exciting to be into sectors that just want to keep going up and up and up, and you avoid these massive drawdowns. It's a pretty exciting time going forward. So now we're coming into step number 3, which is manage risk in positions or die. This is where everyone, most people, 95% of them start to fail in their trading. Now, this is super complicated. Well, it's not super complicated, it just requires a little bit of effort, but I'm breaking it down in a really simple way here. At the end, I'm gonna give you my book. I usually sell my book for $19.97. There's a chapter on there on position management. Sherry can post that link at the end, or I can, and you can read that chapter because there's a little bit more to it, but we don't have time here. The reality is position sizing is how you're gonna manage your overall risk. If you take on too big of a position and you take a loss, it's gonna do serious damage to your account. If you take on too small of a position, you're never going to outperform the market. And we can go into that maybe later, but based on what I'm going to show you here, I'm going to give you everything you need to do this position and risk management for this strategy, so you're all good there. Next, you got to take profits for consistent returns. You never know if the thing's going to run 7% or go 200%, so you have to be scaling out of these winners and keeping a runner. We'll cover that. And you've got to exit positions to limit your losses and lock in gains. No more holding on through a pandemic crash and riding that whole wave out. If you did, you are absolutely not applying any management or risk stuff to your trades. It's just, you definitely need exactly what I'm going to teach you here on how to manage those positions. All right. So once you've found those 3 trades, you know when to get into them, and you know what you're going to do. You should make up 3 of these kind of little tables here, and more or less you're going to put in your symbol. We know we're going to open the next, enter the trade the next day at the opening bell, and whatever amount of money you're allocating to this strategy, you are going to divide by 3 because there's 3 positions. So a third goes into each of these 3 sector ETFs. And then, as I'm going to show you in a minute here, we put in your target prices for a 7%, 15%, and 20% target to take profits. You scale out a quarter each time. And then we let the last quarter of that trade continue to run as a runner. You never know how far it's going to go, and those runners can make a lot of money. And initially, when we get into the trade, you throw a 15% trailing stop on just in case this market wants to roll over and go straight down. So here is a quick visual of what this looks like. Say you get a buy signal here in the market becomes favorable, you get into a trade, you put in your initial stop, and as price moves up, it's naturally going to move up with it. Most brokers have a trailing stop. If yours doesn't, you got to do it manually or move on to a more significant broker. And then these ones up here are our profit targets. So you can see here, you get in, hit target 1, target 2, target 3, runner, and then eventually the trailing stop gets stopped out up here. And then we get into some other trades and chop going forward. So it's a pretty simple strategy. It allows you to continue to profit from big winners, but it also allows you to lock in gains, reduce risk, because you just never know when this thing is going to just tank, roll over on you from whatever news or some type of event going on. So here's an example of the table. If you were to chart these sectors in say an Excel file, you've got your 3 symbols, you've got your date of entry, you've got your entry prices, your percent of your overall portfolio that you're applying, and we got our target, 7, 15, 20. We scale out as we hit those. Some of them hit them, some of them don't all get hit. But take a look at this. We hit all the targets, and then our trailing stop got us out for another gain, hit a target, gain, 2 more targets, still got out with a small gain for the balance. And during this time when we are actually pulling lots of money out of the market, this is when the SP 500 had a buy signal and ended up closing back down for a loss during that time. And this is the benefit of trading leading sectors. Obviously, there's always ones that are pulling the average up. There's a whole bunch pulling the average down. And if we're in the top leaders, they're naturally going to want to keep going up while the market is chopping around. So it's very powerful. When the market tanks, these stocks can hold up very well and stay in trades, or they just get stopped out eventually with a trailing stop and you lock in gains. Believe it or not, the very next strategy right here, or the next signal that we had, this was right after the election. This was the vaccine pop. The exact same three trades that the TWA, PBW, and Hale, which I just showed you right here, these ones, they all actually triggered again. So it doesn't matter if you get out of it and you get back in at a higher price. You want to always be in the leaders. Sometimes they're going to be the same. Most times, one or two of them are going to be the same because the leaders are more likely to stay leaders than they are to roll over. So don't worry about that. The key is to get out because you never know when the market is going to tank and crash. So you're probably wondering how many trades are there a year? So if you take a look at this chart, think of this as roughly 1 year. On average, we have about 5 of these major market signals every year. And because we are trading, actually, we're trading the top 3 sectors, but I'm actually going to show you this, what I call the Band Pro signal. It's the 4th ETF trade that we put on. It's based on the index. We trade it a little differently, but I'll cover that later. But here's the thing. We're going to be putting on 4 ETFs, ETF trades on this signal. So if we got 4 trades and 5 signals, that means we're only putting on 20 trades throughout the year. And the really cool thing is when you've got a buy signal, you're managing your portfolio of all these most likely very strong, fast moving stocks or sectors together. It's like you're managing your own mini hedge fund, and it's a pretty cool experience. And then the really cool thing is when the market rolls over, you get out, you sit in cash, or you go day trading during prime day trading movements. But then you've got time to do whatever it is you want. We had months, 1, 2, 3 months of sitting on the sidelines because of this crash that we just didn't need to take on any extra risk. We were waiting for a new signal. It's pretty priceless. The average is we have 4 months every year that we're actually in cash. And there's nothing wrong with cash. People who think there's a problem with cash, I think they have a problem, because why would you hold on to think you need to be in the markets? And every day there's a green day, you feel good. And when you see a red day on the stock market, you feel bad. And you're really holding at a time when the market is just noisy, and it's just wasted energy, wasted capital, risk, and stress. So we have lots of free time. You can see days and weeks in advance when a trigger is likely to start to be forming. So the crazy part is I recently invented the world's first flying jet surfboard in my spare time. Check this out. This is me on this jet surfboard that's flying above the water. I got my buddy chasing me down. This is my backyard. I live over here. This is like the ultimate superhero toy. It feels amazing. I built it in my garage. I got it patented. I licensed it off to an Australian company who's just about to take it into production. And this is just what happens when you have the financial resources and the time to do whatever it is you want to do. And that's the whole point of why we are trading. We are all here trading to make money so that we can do the stuff we want to do. To take it a notch further, when I was 27 years old, I built my dream home on the water. We've got a big, it's a small pool / huge in-ground hot tub. We love to sail, the family. We go snorkeling, spear fishing. I mean, you can see the fish cruising the coast. I ended up buying my neighbor's property, so we've got a beach house for friends and family to stay. I mean, it's absolutely incredible lifestyle. And I'm all against, I'm not a big fan of day trading. Day trading is a full-on job, high risk every day. What I'm trying to do is create something that anyone who's got a part-time job or doesn't want to turn trading into a job to take advantage of these markets. And I mean, I walk around in the summer, I come down and have my coffee on the dock, and I've been here for 12 years already or so, 13 years. I still shake my head, and so do my neighbors. I mean, I'm the youngest on the street. It's just, I can't believe I live here. I'm super grateful for everything. So this is what's going to happen right now if you don't take action and actually put a real trading strategy together. Money in the bank, zero. Some countries, depending where you're from, are negative. Bonds, you're going to be lucky if you make 1%. The stock market, you're going to make 7 or 8%. You're going to be risking 50+% drawdown. 13 years, depending, NASDAQ was almost like 17 years of a drawdown. Terrible, really, when you can avoid all that. You can trade the best 3 sectors, which I just showed you how to find them. And then the band trader with those pro signals, that extra ETF trade, we can jack our returns dramatically for some pretty gnarly returns. So really the time is now, because the Fed is flooding the market with liquidity. COVID continues to change the world. We're living and working is constantly evolving. I mean, we're in full lockdown in Canada. You can't have friends over. You can't go shopping other than groceries and gas. There's a new president in the States, new policies and taxes. All these things mean money is shifting from sector to sector. And that is why this strategy, sector rotation using relative strength, is the most relevant it has ever been before, I think, in the stock market. And again, those reports I showed you, they go all the way back to 1920. So this is a rock solid strategy that I'm showing you, and it's pretty exciting. So for example, if you were to put in $10,000 and trade it, always getting into the top 3 sectors, you could turn that into $96,000. SP 500 would be around 24,500. So, in 2020, the strategy did 49.1% return. Not bad for a year where a lot of people actually struggled to make a lot of money there. Discretionary trading is very difficult, which means you don't have a real set of trading rules. You're constantly struggling. That's why you need a mechanical strategy, something like this, where all the rules are laid out for you. Again, amazing results. It's pretty exciting stuff. I'm going to go into, here's the offer that I want to show you real quick, and then we can get into some Q&A because time is going to fly. And I'm sure you guys have a bunch of questions, but more or less, you can get the band trader signals. This is a daily pre-market video. We walk through the band list. I'm going to show you how we've got this access to this amazing automated band list. We're going to be trading the top 3 sectors. We're going to manage those positions. You're going to get the app so you can watch the videos, get the alerts on your phone. I'm going to be adding you the Band Trader Pro, that special ETF signal. And then you're going to get this hot list, this Band Trader hot list. If you're an active trader looking for something every week, every month, an endless stream of trades. I'm going to show you this in 1 second. You're going to get a course on how to trade that hot list. And then every month we can get on a webinar as a group, and we can talk about the strategy. You can ask all the questions you want. That's the whole point, is I want to teach you this strategy. And this is what a lot of people do. They'll subscribe. They try coming up with the same trades. And when they start nailing the same trades, you don't need to use my service anymore. Once you know you're in line, you've got it figured out, you can go and do your own thing, or you can stay with the community and get some of the extra bonuses that come with it. But I do have a 100% performance guarantee. If the trader newsletter hasn't produced positive returns for the year of being a member, you're going to get the next year absolutely free. And one of our members here, really we're running out of time, but the best part is she's saying, technical analysis has been an integral part to my continued success over the past several years. Now allows me the luxury of time to do the things I truly enjoy. This is the whole reason we're trading. We want time, and we want to do the things we want to do. Bucket lists, trips, event stuff, spend time with family and friends. That is what it is all about. So again, with this webinar offer through Traders Exclusive here, you're going to get this 4th ETF. It's going to boost our average annual returns. You're going to get this Band Trader hot list, where every day I update this list. It tells us the best rank to get in. We're always looking at the top 10 sectors. The way this works is when there's a new signal, it says new. When there's a green number in here, this means 15 days ago, there was a new signal. And when we get in at the opening bell the next day, it's already up 33%. This one got in 20 days ago, up 30%. 21 days ago, up 13. 5 days ago, up 11. These are explosive sectors. A lot of times they're moving 0.5% to 3% a day. Pretty exciting stuff. And you get all this as a part of this special Traders Exclusive package here. Now you're going to also get the video course on how to trade that, and I guess the monthly mentoring sessions. This is where I'm talking to you right now, and I usually teach people to trade over my shoulder or over their shoulder right there. But yeah, become a Band Trader Pro. No more time-consuming research. Daily videos. You're going to outperform the market with fewer trades, less drawdowns. You're going to profit from this volatility and sector rotation, where actually a lot of people are struggling with, and you can just let me fire off the trades to you, and you can trade them on your own. So that's a pretty darn quick recap of a trading strategy. I hope you guys could keep up. But again, I'm going to paste this in. Sherry, you're probably there. We might have some
I'm
questions. We got to
here.
figure out how to
Yeah.
get these chat questions.
All right, let me see. Okay, so I assigned a bunch of questions to you, and we've got a few more. And guys, if we don't get to all of your questions, we're going to put Chris's email address up there, and you can send them directly to him. And I'm going to go ahead and send this other one to you too.
Okay, so I don't see those yet, but I just sent you a message that has a link to my book,
Okay.
so people can read that chapter on
All
trade
right.
management, chapter 14, and also the course I just taught on how to find the best 3 sectors and how to manage those positions. If you could paste those into the chat for them, and I just got
Yes,
to
I
find out
can.
how to see the rest of the webinar, people.
Okay, so I just got to tell everybody, I just put that link in there. You have to copy inside the brackets or it'll tell you it's a bad link. So just copy that link. You can't just click on it. You have to copy and paste it into a browser. I don't know why GoToWebinar does that, but it does that. Even when I redo it. Okay, here it comes.
I
Send.
hate to say it, but I can't see the questions at all. It doesn't matter
All
what
right.
chat
All
I
right.
open. I'm
Well,
not big into into GoWebinar yet. I haven't done too many of these, so I'm not sure what that is.
okay. So Devendra, he's giving you a trial here right now at Technical Traders, thetechnicaltraders.com/exclusive. Go to that. And I also put it in the chat. You should be able to click on it now. Lars, he says, unfortunately, I can't buy US ETF here in Europe. How could I use the strategy then? Do you have any strategies for
Right.
stocks?
So yeah, we've had that. We're looking into the UK. They're a little more complex. I really know nothing about them. We've started building a UK ETF list. So it's something we're looking at to try to implement and do. I know a lot of Canadians. We're working on a Canadian one as well. I'm Canadian, especially with the US dollar falling. Us Canadians want to now own Canadian ETFs because they're going up in value. So we're looking into the UK. We're looking into Canadian guys for sure.
Nice. All right. And let's see. Do you see 2021 being as good for this program as 2020 was?
I do for sure. I mean, there's always 3 leading sectors that are crushing it. So it's not, even if the stock market is dormant, there's always 3 markets that are just on fire, and there's always 3 that are absolutely the dogs. So we're always focusing on the leaders, and they're going to be moving. And I'm not too worried about it. I know we're going to have huge swings in 2021, and yeah, there's going to be the same opportunity, if not more.
Perfect. Let's see. Does this work on all trading platforms, i.e. interactive brokers?
For sure, that's what I use. So Interactive Brokers has got trailing stops. It's an advanced platform, which is great. So you can apply all these things. I know there are a few other brokers, I think like maybe E-Trade or something, they don't have trailing stops. But all we're doing is buying an ETF, guys. It's if you can buy a stock, you can buy an ETF. So you don't need anything complex. Any broker will do.
Okay, I think I have time for a couple more questions. Fred says, hi, Chris. Once I have my short list of best ETFs in the same sector, how do I determine which one is the best? Can you enter a position anywhere between the buy and sell signal or just at the initial buy signals?
So if I was to go back to, I'm not sure if you can still see my chart or not, but
Yes, we can see it.
yeah, so I think this is what you're asking me. More or less, this is when we initially want to get in on a new signal. You get in and you hold it through there. But really, when the market is running this whole time, if you find there's other sectors leading and you redo the analysis, you could sell your whatever ETF is lagging and buy the next hottest one that's showing up on that list. So you can constantly do it. Obviously, you just don't want to be owning or holding any stocks when the stock market is not favorable for stocks.
Cool. So I got another one. This is kind of long. Joe wants to know, he says, hi, Chris, I'm a few weeks into using the band strategy and love it. After looking over the list of top performing ETFs, I've noticed that many of them are correlated. As time goes on, I can imagine reaching a point where I've run out of uncorrelated ETFs to choose from. If that happens, would it be appropriate to repurchase an ETF in parentheses that I might still be holding 25% of based on my original position, and just follow the same band rules all over.
Yep, yeah, you can. Yeah, you can. A lot of times the trades will still be the same after one signal to another. So you really just, I focus on with the band. Let me just pull it up. You can probably see this is the band hot list. So this tells us where some of these plays are. And if we were to pull up, say, this is a Hale ETF, more or less, this is when we had our last signal. This green box is a band trigger signal, and it's had a really nice run. We've hit all of our targets, and we're up 25% plus. So really, the way this works is when we go back in time, there's going to be a major market buy signal, which if I was to just pull this up, take 1 second here, I can get it to show on the chart. Yeah. So if you take a look at this red bar, this is when the market is not favorable, and then once the market goes favorable, if we've had a trigger, we can get in after that. So there's a lot of time to get into these, and what happens is we would have got in here and rode it all the way up, and if you missed it and there's a new trigger right here, you can get in and continue to go up, and that's what we did. We got in on this other trigger to get back into the band trades and to continue to ride the leaders. So you can keep getting back into them. That's not a problem.
Okay, guys, we're going to have to call it for the day. I really appreciate Chris coming in and doing this webinar with us, and I really hope he'll come back and visit us again. We try to keep the speakers fresh, so it would be 90 days before he comes to us again. We're going to send you emails, so he'll be in touch with you. And I appreciate you being here, Chris. That was awesome.
Yeah, that was a pleasure, Sherry. I haven't done one with Traders Exclusive in years, and I had a blast last time. So well, I'm glad everyone hopefully enjoyed it, and I can't wait to do another one.
All right. All right. So everybody, if you didn't get your question answered, you got to email Chris directly. Like I said, you're going to get email from us, but send him your question, and I'm sure he'll answer you. So Chris, I hope you have a wonderful rest of your day, and I look forward to having you back again too. Thank you very much.
Yep. Thanks, Sherry. Thanks everyone for attending. I really appreciate it. Thanks for sticking it out. I was fast. Take care.
It was fast. Thank you. Bye now. All right, guys, here we go. I'm going to bring myself back as the presenter, and I've got to show you. We have sponsored today, Dan Passarelli at Market Taker Mentoring has sponsored this webinar today. He's having another webinar tonight at 7 p.m. Central, 8 p.m. Eastern. It's a complimentary webinar on how earnings trading can be your most profitable trade. The link that you're going to want to jump on right there is just markettaker.com/earnings. I'll put that in the chat in a little while, but now I want to introduce to you our next speaker, who is after I practiced, he's probably over there laughing at me right now. Eusebio Nanni of Max Trading System LLC, and he's going to talk to us about the secret ingredient to better trading, to better trades. Eusebio is a full-time trader. He's trading the Max Trading System exclusively for 10 years. He's not had a losing day in more than 3 years, and he has 36 years experience trading stocks, futures, and Forex. Mr. Nanni's trade skills are enhanced by his extensive work in engineering and banking. His focus on trend trading systems, global context, and insistence on strong money management techniques has brought him into the limelight as one of today's premier traders. So I'd like to bring him on as our presenter right now. And I always am a little lost on here. It just seems like it's never in the same place twice. So bear with me for just a second. Here we go, Eusebio. There we go. Are you with us?
I'm with you, Sherry. I'm just showing my screen. I hope you will see it.
I see it very well. Take it away.
Okay, and is the audio good also? Do you hear me well?
You sound very well, like you're in the next room.
Okay, thank you very much. And thanks for your amazing technical support. So welcome to all the participants today. And what I would like to present to you is one important ingredient many professional traders, especially in the banking industry and the big institutions, are also using in order to define or to determine in which direction they have to invest or trade their own position. And I mean the global context. Sometimes I will use the term market sentiment because they are very often synonymous, similar. And the content of today, I will present myself in a few moments. The content of today is how to define a trading method. It is important to have a trading system, indeed, when we want to trade any market. And then I will define what is the global context, how I define the global context. And I will illustrate with some quick example. Then an important aspect will be where to collect the information we need to define the global context. And then what may be a daily routine to establish the global context. And so before that, I would like to present myself very quickly. So my name is indeed Eusebio Nanni. I am a Max instructor for since 2009 now, so more than 10 years. And I am a full-time trader since 2008, especially in the Forex market. Before that, I was a service manager in the IT industry for around 30 years. And the 15 last years of my career has been dedicated into the banking industry. And this is why working with some big banks in Europe, I have had the opportunity to work with some bank traders. And so with that, I have learned a lot, of course. But I have been interested in investing in trading in many markets for more than 35 years now, when I have just begun my professional career. And so I have been interested in the past with the stock market, the options market, the futures market, and since 2000, in fact, the Forex market. And what I'm going to present today is especially dedicated to the Forex market, but can be applied to any other market. I'm not alone in the Max Trading System team. I have two other friends and partners, Craig, who is the sales support manager, and Chris, who is responsible for the technical support to our members and also responsible for some coaching aspect to our members. Before presenting the subject, just a quick disclaimer. I don't have a written page for the disclaimer, but you know what the disclaimer is. So this presentation is for education purpose only. We do not provide investment or trading advices. Investing or trading always presents risk, so do not invest or trade money you cannot afford to lose. And of course, past performances are not indicative of future results. So that being said, so when it is important to define a trading method, and I will explain why in a moment. And to do that, our approach is, first of all, to define the movement we want to trade. What are, for example, the trends we want to trade? Then we need to define when such a trend may possibly start. And we do that through some entry setup patterns. The price action is essential to define when a trend can possibly start. And then we have to validate such an entry setup, because it's not because we have an entry setup that we have necessarily a trade. We have to validate that setup, and for that we use a combination of technical analysis, risk analysis, and global context analysis. And sometimes when especially we day trade, we can include some other very specific conditions. And so what I'm going to focus today is the global context. Now, when an entry setup is validated through all these types of conditions, then we have a trade, and then we have to define how to handle a trade. How do we size the trade? And we use the position sizing concept in order to fine-tune the risk we want to allocate to the trade. And then we have to progressively focus in the way to reduce the risk on the trade, sometimes canceling the risk of the trade, achieving trade risk-free. We can, of course, scale in along the trade. We can scale out along the trade in order to optimize the profit. And then we have to define when the trend possibly exhausts or reverses in order to close the remaining open position. So we have at the Max a very complete trading methodology. But today I would like to focus on the global context. And so what is the global context? I will define that in a moment. There is sometimes a common belief among many traders that the market is moving randomly. If this is the case, a strategy most probably will not help. But in fact, when we observe some chart or many charts, we can see that there are no random movement. In fact, the market are driven by a certain number of factors. Understanding these factors and their evolutions will help to predict the future movements in the market, whatever the market we want to trade. An example of indication or information or driving factor we can use is to analyze the 10-year or the 2-year usually US Treasury bond. I take just 2 examples, but there are many other data we can analyze. And I will take a long-term perspective, for example. And so when we analyze the evolution of a currency pair, based with these 2 treasury bond evolution, we can see, for example, here, if I take the euro-US dollar, the euro-US dollar is the chart in blue, and the 2 other charts represent respectively in black the 2-year treasury bond and the other one, the 10-year treasury bond. And when we compare the 2 charts, the 3 curves, sorry, we can see that there is very often a negative correlation. When the treasury bond yields goes downward, the euro-US dollar goes upward, and vice versa. When the treasury bond yield goes upward, the euro-US dollar goes downward. This is for the euro-US dollar. So the direction of the movement of the pair depends in terms of correlation of the position of the US dollar, in this case, in the pair. In this case, the US dollar is the quoted currency. When we take a pair where the US dollar is the basis currency, like the US dollar CAD, we see a positive correlation. Now, when we make a deeper analysis of the correlations, we will see that the correlation is never always perfect. Sometimes the price moves in a different way than the macroeconomic data we can analyze. And the reason is because the market depends on many data, many information or factors. Furthermore, in this case, we do not take into account the yields on the other currency bonds. And so a more complete analysis need to take into account both sides of the pair, what is happening on the US dollar side and what is happening on the CAD side in this example. And when we make such a more complete analysis, we have a better understanding why a pair is moving in a specific direction. And for me, it makes sense to trade a direction only if we understand why an instrument we are trading is moving in such a direction. A very recent example of that was last week when I have prepared this slide. It was last Thursday or Wednesday, the 14th of January. And the global context analysis has shown that we had a very weak euro, a strong pound, a weak US dollar, and a strong equity market, so a strong stock market. And when we observe the evolution of some pairs, I will show just some of them. So here we have the euro pound. And so my bias on the euro pound was to short. This magenta vertical line represents, at the moment I have established the bias, my bias on the underlying instrument, so the euro pound in this case. Magenta vertical line represent a short bias, a green line represent a long bias, and in this case my bias just after the London Open, which was around 15 minutes earlier, has been established as a downward bias. And so at some point the price has reversed, has made some pullback, and after that the price has reversed following the bias I had established a few minutes later, giving a nice trade we can trade with one of our trading systems. So another example was the euro CAD. Similarly, the bias was short, and again, the price at some moment has pushed to the downside. So because the euro was very weak that day. Similarly, the pound US dollar with a strong pound has given before a nice rally to the upside following the global context bias. So has been preceded by some correction, and then the price has complied to the buyers. The pound Swiss, similar behavior. The stock market, as I have said, was strong. This is, for example, the Nasdaq, and the Nasdaq index, in fact, has followed the global buyers now to the upside. And I can show a lot of examples, but I will limit due to the limitation of time. I will limit for just some examples. So what is the global context? A very simple definition is the global context represents everything we need to predict the market movements. Of course, when I say that, I say nothing, of course. A more complete definition is to consider the types of event driving a specific currency. And among these types of event, we can consider, first of all, the news release or the economic data, the politics and the geopolitics event, which are extremely important in terms of currency trading, but also the central bank decision in terms of monetary policy, interest rates level, and also their daily operation. Many traders, especially the retail traders, forget that the central banks make also daily interventions in the market. And these daily interventions have an impact in the respective currencies. And then the global risk sentiment. When I talk about risk sentiment, I mean, is a market risk on or risk off? You all know that concept. And so this is something we have to also take into account, and that may be establishing by analyzing the relationship between several markets. For example, the gold market or the silver market, but also the bonds market, and so on and so on. And so every day, in fact, one or several of these types of events will influence a specific currency we are interested in. And it will be our task to define which of these events may be possibly a trigger for a movement or a trend in the market. Another example is the influence in the market with a central bank decision. On March 4th, last year in 2020, the Bank of Canada has cut its overnight rate by 50 basis points. By the way, today we had also a Bank of Canada decision, keeping everything as decided the previous months. But the market expectation was precisely a 50 basis point rate cut. And so if we observe what has happened before the central bank decision, the Bank of Canada decision, we can see that on the previous year, in fact, the interest rate has been unchanged. And then there was an expectation for a cut rate of 50 basis points. And this is what the Bank of Canada has made indeed. And so in such a case, we have to expect the CAD to strengthen. And when we observe the chart, here I'm using the US dollar CAD to illustrate that concept, we can see that this very big blue bar you see here is what we call a spike of around 100 pips in less than a few minutes. In fact, just after the announcement by the Bank of Canada, we can see that before the announcement, there has been some anticipation for such a decision. And then after the decision, the market has spiked. And usually when we have such an announcement, the market will react in 3 or 4 steps. The first step will be possibly, in the case of an important decision, a big spike in the direction of the decision, followed by a pullback and then a continuation or a resumption of the fundamental data, which can last several hours, 2 hours to 6 hours in terms of day trading. And sometimes when these decisions are extremely important and may have a medium-term impact, we can see that on the following days, following other interest rate cut by the Bank of Canada, the Canadian dollars has continued to strengthen against the US dollar. Of course, in order to define if specific currency will be stronger than another currency, for example, the CAD against the US dollar, we have also to analyze what is happening on the US dollar CAD. But this gives you an idea that if we understand the global context of this kind of decision, we can predict most of the time where the market will go. And so the global context, however, must be constantly reevaluated in order to adjust how we see the market moving, because sometimes the price will not always move as we may think in such a basic approach I have just presented, I have just illustrated a moment ago. And let's suppose the following scenario. Let's suppose that the Fed, we expect the Fed to cut its Fed funds rate by 25 basis points. At that moment, because of that expectation, we can suppose that, or we can expect that before the Fed announcement, we should see the US dollar weakening. And so we could, for example, go long on the euro US dollar. Going long on the euro US dollar means buying the euro, selling the US dollar. When the US dollar weakens, we can sell the US dollar. But after the Fed announcement, we see that, in fact, on the contrary, the US dollar has begun to strengthen. And this sometimes happens. The currency does not behave as we have expected. And why that? Most of the time, the reason is because the global context analysis we have made is not precise enough. We need to go deeper into the vision we have of the global market. And so let's analyze indeed the following scenario, which can explain why the price does not always follow the way we expect to. So let's suppose the recent statement of the Fed has been, and if you follow the press conference of the Fed after a Fed announcement, you will, or if you read the Fed monetary policy statement, you will often see or read statements like the following one. If inflation falls below 2%, which is the mandate of the Fed, we will cut the interest rate by 1%. So at that moment, as soon as we read that statement, and supposing that the current inflation is indeed at 2% and the market is expecting on the next announcement on the inflation, an inflation, for example, at 2.1%, at that moment, we expect that the Fed will do nothing because the inflation is on target. The Fed has the mission to maintain the inflation at a specific level at 2% or close to 2%. And so in this case, if we have the expectation that the Fed, the inflation is around 2.1%, so we can expect, due to the previous statement, that the Fed will do nothing. And so now let's suppose that the inflation data, the CPI, the Consumer Price Index, for example, is released at 1.1%, so 1% below the expectation, way below the target established by the Fed at 2%. At that moment, we can expect that the Fed will indeed cut the interest rate by 1% at its next meeting. And remember, the Fed meets 8 times a year. Not every month, but around 8 times a year. There are sometimes exceptional meetings or announcements depending on the circumstances. And we have seen such circumstances with the COVID in 2020. So now we are expecting that, due to that expectation on the Fed decision, that the dollar will sell aggressively, and so we can sell the US dollar. But then comes the Fed announcement. And the Fed announcement is that the rate cut is only 0.5%, a quarter of a percent, 25 basis points. So what will happen to the US dollar? We still have the Fed having cut the interest rates, but then, because the expectation was for a much more important cut, things is better than the situation. And so this is why, in this case, the market will reverse its direction and will strengthen the US dollar, buying the US dollar, because of the market has previously overestimated the expectation for the Fed action. And so with a much larger and deeper analysis of what is happening in the market, so we can be much more precise in the way to understand why a price is moving in a specific direction or in another. Another typical example, well known for several years now, is the Brexit. When there has been the referendum Brexit on this vertical green line in 2016, so the expectation was for the Remainers to win this referendum. And at the surprise of the market, the Brexiters have won the referendum. And so we have seen the pound weakening strongly and the pound selling off very, very aggressively. When we see such a very aggressive sell-off, there is always some rally. But then, between the moment of the referendum And today we have seen a lot of movement. Before Boris Johnson became prime minister in UK, it was Theresa May who was the prime minister. And the negotiation between when Theresa May was the prime minister were very not very aggressive, and so because Theresa May was not very convinced that the Brexit should be done, and so in fact, what has happened in that period is the following. It was a very strange behavior, but this is what we have observed. The big boys, and by big boys I mean the traders in the big banks or the big institution, were expecting a no-deal Brexit. And so whenever there was an information on the European Union part or on the UK side that a no-deal Brexit would be achieved, this was good for the pound, and we were seeing the pound strengthening. And whenever we had good news about the deal, a possible deal, we were seeing the pound weakening. And then came Boris Johnson. On this vertical line, Boris Johnson became the prime minister instead of Theresa May, and then progressively the market sentiment has changed, because at the same time we were seeing that UK was establishing a lot of trade deals with many other countries around the world, and so the market came to the conclusion that even the no deal Brexit would not be so catastrophic for UK, and the behavior of the market has changed. Starting with Boris Johnson, Prime Minister, we have seen that whenever we had a good news for the Brexit deal, this was good for the pound, and whenever there was some indication of a no-deal Brexit, that was bad for the pound, until the Brexit became effective, and now we are seeing the pound progressively strengthening. Of course, what I have shown here is on a longer term perspective, but we can go into the detail of this kind of analysis even for day trading. And so the problem will be where to collect the informations. We need to establish the global context. Based on what I have explained about the different types of event we have to consider, we have a lot of resources we can exploit. For the news release or the economic data, we have at our disposal the economic calendar, and there are a lot of them which are available. There is the economic calendar of Forex Factory, FX3, Daily FX, Investing, and so on and so on. If you Google with the keyword economic calendar, you will find tons of economic calendar, and I will illustrate one of them in a moment. In order to better understand the impact of the politics and geopolitics, we can read some financial media. And when I say read financial media, I don't mean that we need to spend hours and hours to read the newspaper, for example. No, just simply read the headlines some medias are giving. And there are some of them which are extremely interesting on that point of view: Bloomberg, Reuters, the Wall Street Journal, the Financial Times, and all these information most of the time are free of charge. For the central bank policy and their daily operations, of course, we can consult their website. Their websites are totally free and they contain tons of information. We can also read the report, the periodical report written and sent to their customers or members by an important number of banks. For example, JP Morgan, Goldman Sachs, Crédit Agricole, and so on and so on. But we can also analyze information given by an interesting website like the CME Fed Watch tool, which is relative to the future interest rate established by the corresponding central bank. For example, here I will illustrate an example with the Fed. And for the risk sentiment, the global risk sentiment, we can observe the behavior of some very special instrument or market like safe haven currencies like the Swiss, the yen. Whenever the Forex trader perceive there is risk around the world, they invest better in these two types of currencies. And when they perceive there are less risk, they invest in other more volatile currencies like the Aussie, the Kiwi, not the yen, the euro, the pound. But we have also to observe the behavior of some commodities like gold, for example, which is also which is also considered as a safe instrument or safe asset, but also observe the behavior of the bonds market, because all these markets are interrelated, in fact. And we can, in terms of perception of the volatility in the market, observe what is happening on the S&P 500 VIX. The VIX is the fear index instrument. This is an example of the Forex Factory page. I will not go into the details if you go on their website, so you will have all the information you need, but basically we have for each currency at due time every day the description of the news, the release data in this column, which is empty here today for the portion I have shown, the forecast the market is doing, and the last release data on the previous announcement. And you can also observe some historical data if you use that kind of icon. This is, for example, the website of Bloomberg, dedicated to the currency market. And on that page of Bloomberg, so you have here on the left side of the page, you have some headlines. And you have to pay attention to use only the headlines of the present day, of course, in order to know what is happening globally in the market. And when I analyze these headlines, I only focus on headlines which gives objective facts, and I ignore all the opinion given by someone, whoever that someone may be. But these information, again, are free to access. Then the Fed. This is an example of a central bank, the Fed, the Federal Reserve. Its website gives a lot of information, and one important report to read at the Fed announcement is, of course, the FOMC statement. And you have always here the most recent document, and that FOMC statement describes the monetary policy decided by the central bank and how they establish and why they establish the Fed funds rate at such a level. But you can read a lot of other tools which are available to make a better idea of the finest detail of the global context. And this is an example of the daily operation of the Fed. The Fed puts or withdraw money in the market, and depending on the level of money the Fed put or withdraw from the market, this will have an effect in this case on the US dollar. Another very important tool to observe for every central bank is, in this case for the US dollar, the Fed Watch tool, which gives, in fact, depending on the months we are interested in, for example, here I have displayed what we expect for the next announcement by the Fed in a few days. It's the probability that the Fed funds rate will be established at such a level. In this case, we have a 100 probability that the target rate will be between 0 and 25 basis points. 25 basis points is 1/4 of a percent. So we know for sure, almost for sure, because certainty never exists in the market, but the decision of the Fed next time will be to not change the interest rate of the Fed funds rate. And so doing so, we have an idea how to position ourselves when we consider a trade containing the US dollar. Of course, when we have collected all this information, and with some practice, it doesn't take a lot of time. It takes me around 1 hour every day at the very beginning of my session. So my daily routine to establish the global context is the following. I collect all this information to define an initial global context for each currency I want to monitor, because each pair I want to trade is based on these currencies. And then I identify what are the events most likely able to change the global context. And these kind of event will be most of the time the news releases, but not all the news releases are important. Some are important and some can be completely ignored. And then once we have established these events, when they happen, when the news are released, for example, we have to analyze the nature of the release data in order to confirm our global context or to change the global context in the opposite direction or to something else. Now, of course, this represents a lot of information to consider, to collect, and to analyze before coming to a conclusion. And for that, in order to help our members, And we have over time formed more than 2,000 traders around the world with our trading approach. But in order to, and we want them to be as independent as possible, but to help them to establish their trade and based on the global context, we provide them a lot of information we are collecting, we are assembling, and we update every week. On our website, so we establish what we call the weekly news watch list. And we establish a list of points, a list of events, geopolitical and political events we have to pay attention, because if something happens, good or bad, on this point, on this type of event, we have to expect an important impact in the market. Typically, of course, the US dollar Federal Reserve decision, the pound with the Brexit, and so on and so on. After that, we establish a simplified economic calendar. For every day of the week, we eliminate all the news which are not important at all, and we keep only the news which may have an important impact depending on how the related data will be released. And then after that, we establish a list of the most moving pairs. What are the pairs which are moving the most? Because of course we are interested in making profits trading trends, and to make profit trading trend we need to find trends, and a trend will be more able to develop if we have a moving pair. And so we establish the list of the most moving pairs, and after that we establish for each day of the week, depending on the news release, what are the pairs we have to mainly focus. We don't need to focus on all the pairs. If we consider the 8 main currencies, we have 28 pairs. It makes no sense to monitor all these 28 pairs. We have just to focus on some of them. And so this is the web address of our page where we update all these information. So mactrading.com/newswatch. This is an information mainly for our members, but it is a set of information which are freely available to everyone. So even if you are not a Max member, you can still exploit these informations if you want. So the access to that page is completely free. After that, so we provide also, in terms of service, the directional bias for a lot of pairs, a certain number of pairs, the stock market with a certain number of indices, the commodities market with just 2 commodities, crude oil and gold, and then 2 examples of bonds in the bonds market, based on the approach I have just mentioned a few moments ago. And when we see on our bias page an up green or up green arrows, this means that the bias for that pair at that moment should be considered long, and we have to consider or to favor only long trades. When we have red down arrow, we have to consider short trades. And so let's see, for example, today. Today, in fact, if I can change my screen, this was the bias for today, and let's examine simply some pairs. So, and I have concluded that today we had a very strong Aussie and Kiwi currency, a strong CAD due to the expected decision by the Bank of Canada today, and a strong equity market, stock market. And so I will show some examples. This was the euro Aussie dollar, so strong Aussie. So we had to sell the euro Aussie. My bias was short, starting just a few minutes after the London open. Similarly, on the euro Kiwi, with a strong Kiwi, the bias was short, and the price has nicely moved downward for the euro Kiwi. And along such a trade, we can, of course, with the appropriate rules, scale in, scale out, and then finally close the trade when we see the movement is exhausting. And we have rules to establish when the movement is exhausting. In the stock market, for example, here we have, this was the Kiwi US dollar with the Kiwi as the basis currency. A strong Kiwi means that we have to buy the Kiwi US dollar, and we can say the price finally has moved upward following the market bias. I could show a lot of such examples, but let's see the stock market with the S&P 500. And so my bias was long on the S&P, starting with the London Open, and we can see that when the stock market has opened, so indeed the stock market has moved nicely higher today. This was true for the S&P, but also for the Dow Jones and for the Nasdaq. So we can see that using the global context, this can help to choose the best trade. And when we take trades in agreement with the global context, we achieve around a 90%, sometimes more, a 90% winning rate, which is a great winning rate. I established also the bias for long term for our members who are interested in position trading or swing trading in a very similar way. And of course, for those who want to become independent in their trading approach, we provide courses which help to develop the confidence in the skills of the trader. We provide a lot of mentoring. We provide a lot of activities which are most of the time free, also like free workshop, free practice session, and so on. But we propose essentially two courses. The Max ETF standard course. ETF here is not a financial instrument. The ETF means enhanced trading format, which is our flagship course. And we provide also a very summarized course, which we call the primer course. And the difference between the two courses are the following. The ETF standard course is the complete methodology, which is based on 7 class sessions. So it lasts for 7 weeks, 1 session per week. We consider multiple entries and exit scenario based on concept and rules with a very high effective profit acceleration through to the scale-in and scale-out mechanism, providing between 30 and 300% more profit than simply opening a trade and then closing a trade based on entry and exit rules. But with a very strong trade risk management and strong money management. The ETF primer course is limited to 2 class sessions with basic entries and exit, a limited set of entries and exit, which is still very profitable, not as profitable as the standard level, of course, with a simple risk management, but still very effective. And the aim of the ETF primer, for those who do not want to invest immediately in the ETF standard course, is to have an idea if the concept we are presenting are interesting and if we are legit in teaching how to trade in the Forex market. And of course, we have an offer providing some advantage, some discount for the participant of today, session. So you have the price here. So the regular price for the ETF standard course is $2,999, and we provide a nice discount at $2,399. For the Max Primer course, the price is very small in such a way that everyone can afford that price. It will be $159 instead of $329. You have the link here if you want to have more information. But if you want to have more information, so you can always contact us at our email address, support@maxtradingsystem.com. You can even contact us through Skype. Our Skype ID is maxtradingsystem2, and we will be glad to answer all your questions. We provide also other type of information, the bias as I have just explained, but also supply and demand price levels. And we have also a subscription for these services at very reasonable price, and I give you the link you can access if you want more information about these services we provide. So this ends my presentation, and so if there are some questions, I will be very glad to answer these questions.
All right, let's just check for questions. Folks, it's time to write them down. Someone did ask if you speak French.
Yeah, I speak French. I live in France, sorry. I'm not French, I'm a Belgian. This is why my English accent is worse, is very bad, yeah.
Oh, but the Belgian is very close to French, is it not?
Yeah, indeed, we have a common border, indeed.
Okay. All right. Well, I'm not seeing anything here. Folks, are you typing? Are you looking to write something in there for Eusebio to answer?
And anyway, if you have questions,
Now,
Yeah,
do
and
I
if you
have
have,
your, let me see. Let me just put your email address there because if folks need help with this, I do need that link, the link where they should go. I'm not seeing it. Hold on, get that out of the way. Is there a link that I need to give them for the offer that you just presented? Can you
yeah, it
type
is
it
the link I
into?
have presented here, support at
So, okay,
maxtradingsystem.com.
that's the email address where you want people to talk to you.
Yes,
X Trading, SYSTEM.com. All right, folks, and you're also going to get an email from Eusebio when we're done today, and you will have this link. Remember that he'll answer your questions, and you'll be able to see the link for this offer. Is that true? Will you send them an
that's true.
email?
That's correct.
All
Yeah,
right.
indeed.
Thank you so much for joining us. I think
My
let me
pleasure. It
make
has been
sure I
a
don't
great
have
pleasure.
any others.
Yeah, it has
Somebody
been a
may have
great
typed
pleasure.
one.
Yeah.
Questions. Let's see. Always a pleasure to listen to you from Dan. All right, folks. Well, we're going to let him go. I know you have lots to do. I thank you so much for joining us, and I hope you'll come back again in the future.
With
And
pleasure, indeed.
thank you so much. Okay. Oh, you're in Belgium, right? So it's kind
No,
of
I'm
late
in France.
there.
In
You're in
France.
France. You're in
In
France,
France,
but
yeah.
you're Belgium. Okay, I'll get it straight. But I mean, it's what, around 8:30, 9 o'clock at night there?
It's 8:30 p.m. indeed.
Yes. So thank you so much for staying after. I don't know if you work that late usually, but we appreciate it. And
I always work late. I wake up very early and I stop working very very late indeed. Simply
awesome.
because trading is a passion. So
All right, let me just do this again over here. I was supposed to send this out to everyone. I want them to see your email address. And there we go, support@maxtradingsystem.com. I would like to put it in the chat so that they can actually copy and paste it, since they can't copy and paste it from the slides. So I wish you a wonderful rest of your evening, and I appreciate you being here, and thank you very much.
my pleasure. See you soon and goodbye.
Goodbye. All right. Next up, we have Barry Burns. I'm going to remind you that this presentation is being sponsored by Dan Passarelli at Market Taker Mentoring, and he's got a bonus webinar tonight, 7 p.m. Central Time, 8 p.m. Eastern Time, on how earnings trading can be your most profitable trade. And it's at markettaker.com/earnings. And I can send that to you here. And we'll send that out. Now, I'd like to let you know that we're really happy to have Barry back with us. And he is Barry Burns of Top Dog Trading with Advanced Fibonacci Made Simple. And Dr. Barry Burns started his study of the markets under the direction of his late father, Patrick F. Burns, who accumulated 70 years of trading experience in his lifetime. And just a few of Barry's accomplishments include he's the author of Trend Trading for Dummies, seminar presenter for several exchanges, including the CME Group and Eurex. He's the author of Top Dog Trading 5 Energy Methodology plugin for Metastock. He received several years of Reader's Choice Award for technical analysis websites and trading schools by Technical Analysis of Stocks and Commodities magazine, published many articles for various outlets, including eSignal Central, and founded Top Dog Trading to help students shorten their learning curves in becoming traders. So I want to welcome Barry. Barry, can you hear us? Are you there?
I am here, and yes, thank you so much for inviting me. I'm excited to be here. Thank you for putting together this.
We're excited that you came
great
back. All right, so I've made you the presenter, so you can take it away.
All righty, thank you. Yes, all right, let me bring up my slides first then. Make sure that that's working. All right, we'll bring up, Hey, let's see here. Yeah, we'll just bring up the monitor, bring up the whole monitor. That's usually the easiest thing to do.
I can
All
see
right,
it.
you can see it.
Yep.
Excelente, muy bien,
All right.
ausgezeichnet. Um, I'm not as internationally fluent as our previous presenter, and I also don't have the sexy accent, but I'll do my best.
All right. Well, you have the floor.
All right, and I have 45 minutes, is that correct?
Yes, you do, but we like to have a couple minutes at the end for questions.
For questions, right. Okay,
All right.
excellent. All right.
I'll be back in about 40 minutes.
Okay, excellent. All right, well, welcome everyone. Thrilled to have you here, thrilled to be here. I love this topic. I haven't done this one for quite a while, but it's one that, most people know something about Fibonacci, but I'm gonna go and show you some things that maybe you haven't seen before. So that's why I call it Advanced Fibonacci Made Simple, because we're going to go beyond. We'll start with the basics. We'll make sure everybody's on board, and we'll start with Fibonacci 101. And then we've got something for everybody here. We're going to intermediate level Fibonacci, and then we'll do some advanced stuff that I'll bet you by golly, wow, you haven't seen before. Boy, that's an old reference. All right, a couple of house rules. I know that you've seen the legal disclaimers before, but during these multi-speaker events, people come and go, so I just think it's important to remind you. When it says no questions till the end, I can't actually see your questions right now anyway, but I will leave some time at the end as requested to answer your questions. I just want to make sure that we get on time so that we stay on schedule and focus on the presentation, and then open it up for Q&A. Please don't trade with money you can't afford to lose. Very important. Trading is very risky. All information in this presentation is for educational purposes only. I'm not giving you any specific advice for what you should trade. Trading is risky, as I said. Most people don't make money, and it is a profession. So come with a professional mindset and not a get-rich-quick mindset. It is not a get-rich-quick game at all. Well, the introduction was already done, so I appreciate that. I'll just skip through this slide, save us some time so that we can focus on the content and on the good stuff, the Fibonacci stuff. Boy, got a lot of stuff there. Okay, so let me bring up my little pointer. A little laser beam. What do we got here? We got spotlight. Okay, awesome. So let's just start out with the basic concept of how most people trade Fibonacci. So most people use it for retracements in a trend. And the way that you draw this, you'll have a drawing tool on your charting platform. The drawing tools, their robustness varies from one charting platform to another. So we're not going to get into details with that. You can contact your software provider and ask them, or go through their tutorials as exactly what buttons to click and so forth to get the Fibonacci retracement. So we'll start with Fibonacci retracements. Again, we're going to go into other techniques as well, but the basic concept of Fibonacci retracements is you look for a major swing high, you look for a major swing low. You draw the line, you click your button here, and you drag down here and you click your button there, and then you're done. Now, what the tool will do is it will draw these horizontal lines at these ratios. So these are, you can write these down if you want to, but these are the percentages that I use: 23.6, 38.2, 50, 61.8, 76. So just a big overview picture is we're looking at these as, so we've got this impulse move down, so we got a trend down, and we're looking for a resistance level to enter back in the direction of the trend. So these would be the resistance levels. Will it stop here, retrace, and go down there, or up here to 38? Okay, this time it goes to 50, and then it goes on down. So that's the basic concept. Broad stroke meta pattern is drawing levels of resistance in a downtrend to look for an entry in the continuation of a downtrend. Obviously, the opposite, if you're in an uptrend, you're drawing these as support levels for retracements to go long. All right, and I found by doing this presentation before that it was just really helpful for people to get this kind of broad picture first. And now let's get into a little bit of the details. All right, well, where do these Fibonacci numbers come from? Well, they're a sequence of numbers named after Leonardo of Pisa, who was known as Fibonacci, which just simply means son of Bonnocchio. And he introduced the sequence to the West in 1202, but even though he's credited with it, the sequence was actually discovered before him independently in India, long before he came across it. But that actually gives extra credibility to it because it was independently discovered in two different parts of the world, and both of them found it very significant. So what are Fibonacci numbers? Well, they're a sequence of numbers, and the sequence is actually up there in the heading for you, so you can kind of reference that. We'll look at it a little bit more. So just a little header there. Took a lot of time to do that. So anyway, that's the sequence. We'll look at it a little bit more, but essentially at its core, it is not about percentages. It's about the sequence of numbers. And the sequence is simply a mathematical sequence, begin with 0, 1, then each subsequent number is the sum of the previous two. All right, so this is a mathematically based methodology that again has been found to have mathematical significance in many, many things. So some examples here of what we just described. So you take your, let me get my laser beam back on here. So here's the sequence. So you just take 0 plus 1, start with 0, and that equals 1. Okay, pretty, you know what? GoToWebinar made a change here where it doesn't let me move forward with when I've got my spotlight on there. So I'm just going to have to use this. All right, so then we take 1 and 1 here, add 1 and 1, and you get 2. So that's why there's the number 1 here. The next number in the sequence is 2. And then you simply take the 1 and the 2 from this, and you add them together, and you get 3. And so the sequence is 1, 2, 3. All right, well, so far we're just counting one by one, but now it starts to switch up a little bit. So now we take the 2 and the 3 from this addition, and you get your 2 and your 3. Now you get a 5. So the number 4 is not in the sequence. So it goes 1, 2, 3, 5. Then you take these two numbers, 3 and 5, add them together, you get 8. 8 is the next number in the sequence. And you just do this forever and ever and ever, amen. 5 and 8 equals 13. 13 is the next number in the sequence, and it just keeps going like this to infinity and beyond. All right, so now why was this sequence discovered independently in two different parts of the world and considered significant? Well, because as mathematicians studied this sequence, they found that in the structure of multiple natural patterns, this sequence was an organizing principle of nature. So one of the most famous, probably the most famous, is the Nautilus shell. And you'll often see this symbol associated with Fibonacci numbers, Fibonacci classes, courses, all kinds of stuff, okay? And that's because that sequence, it continues. See how it's all these little dividers are real close together, and these numbers are close together, and then the numbers get further and further and further apart, and these little sections get further and further and further apart. And so that is why that is often used, but it's actually found as an organizing mathematical principle in many natural patterns. Now, we're not biologists, we're not scientists in this sense. I don't know, maybe some of you are, I'm not, but I love science, never was very good at it. But I thought, okay, so let's look at this. Now in trading, how does this apply? So yeah, we've established that it is part of the mathematics of natural structures, but that doesn't necessarily mean that it should apply to trading. So how do we use it in trading? Well, what's interesting is each number in the sequence is approximately 1.68 times greater than the preceding number. And so this has become known as the foundation of the ratios and is called the golden ratio or the golden mean. And people who are very, who put Fibonacci as a very core of their trading, they're often using this 1.618 or sometimes just 618 ratio as the primary one. And they'll only trade off of that ratio, and that's okay. That is one alternative. But it's not the only one. As you noticed, the very first slide that I showed you with the Fibonacci lines on it, it had other ratios as well. So then the other two other key ratios are determined by dividing any number in this series by the number 2 places to the right and the numbers 3 places to the right. So let me show you what I'm talking about here. Easier to really just put this up here like this. So here's our sequence, 61.8 ratio. is found by dividing any number in the sequence that is found one place to the right of it. So, quick example. If we take, we'll just start, you can start anywhere with this. That's the kind of magic of it, if you will. So you take 13, you divide it by the number one place to the right of it, 21, and you get 0.618. Pretty close to, or 619, pretty close to 618, right? And you find that with all of these. So if we go to 21 divided by 34, 617. We go to 34 divided by 55, 618, right on the dot. Now, so that's the goal. This is a primary ratio used by Fibonacci purists. I'm not a Fibonacci purist, by the way. So I look at that level, but it's not the only one that I will trade. So another ratio that's commonly used is 38.2. So how do we find that, and why is that significant? Well, we do the same thing we did for 618, except now we go two places to the right of it. So as a quick example here, go back and use 13. Okay, and then we divide it by two numbers to the right of it in the sequence, and you get 382. Same thing, 21 divided by 55, two places to the right of it, 318. Again, 34 divided by two places to the right of it, 89, 382. And you can do this forever and ever, amen. It's very, very consistent. Now, the 23.6 ratio, guess what? This is very consistently found by going to three places to the right of it and dividing those numbers. So again, we started with 13 on all these, so we'll just do it again. We'll just use one example here because I think you're getting the idea. So we go to 13 and we count three places to the right. 1, 2, 3, 55, and it's 0.236. And you could do this through the whole sequence, pick any number, start anywhere in the sequence, go to the number three places to the right of it, divide it, you're going to get 0.236. Okay, so that's what that is. Now, there's more. So the primary Fibonacci ratio is 61.8. Secondary Fibonacci ratios, 38.2 and 23.6. And now we've got a couple of more. And we've got to ask, well, where did 50% come from, and where did 76.4 come from as support resistance levels from an impulse move, a trend? Well, again, Fibonacci purists, they have come up with ways of explaining how they believe this does relate to Fibonacci. In my personal opinion, Fibonacci is, the way they define it is a little convoluted. That's what purists kind of do. They make things fit. 50% is really not a Fibonacci number. It is simply, halfway between the trend. And there's been whole trading systems based off of 50% retracements as well. They work very well, very consistently when combined with other things as part of a complete trading system. And it's just simply been observed that it's a common support resistance level. W.D. Gann used to use it a lot. 76.4 is not a Fibonacci ratio, but is simply the mirror of the 23.6. So out of 100, if you add 23.6 and 76.4, you get 100% of the move. And so it's just the mirror of 76.4. Now, some traders will actually use 78.6 instead. And again, those are the purists, and they say, well, they use that because it's the square root of 618. And that's fine. In my personal trading, I haven't found much difference whether you use these two. I use this one because it's a little more conservative of an entry. And if I wait for the market to get to the 78.6, it often doesn't quite make it. It makes it more to 76.4 than 78.6, and that gives me more conservative trades. So again, don't look for everything to be to, the decimal point out to, the 7th decimal point and all these kind of details. These are general areas for support resistance. Now, this is in the field of what we call market geometry. And there's all types of different market geometry. You got your Gartley patterns, astrology, you got your squares. W.D. Gann was in this very much. But in today's webinar, we're focused on these simple things. These numbers right here, these numbers that I already presented to you. So 0 and, well, you've already seen them. So if you want to write those down, fine. You're going to see them over and over in the slides I bring up. Oh, and their extensions, by the way, and their extensions. So what I mean by that is, looking back at this example here, so when the market retraces in a trend, So here's our trend from that swing high to that swing low. All right, then it's going to automatically plot after we click on that low, our Fibonacci retracement tool. So what you want to look for in your charting platform is the retracement tool. And as you'll see, there's other types of Fibonacci tools. So for this purpose, you want to use the retracement tool. And I'll show you, okay, what percentage of the market or what percentage of that move, that initial impulse move, is the market retracing back to the beginning of the trend. So from here, that level, it's moving, it's back 23.6% of the initial move or the initial point of the trend. 38, 50, 61, 76, and now 100%. So if it goes all the way back up to here, it's retraced 100% from the beginning of the move. Now, you'll notice that it doesn't, as we pop off this bottom, it doesn't stop at 23.6. You can't trade these levels in isolation by themselves. We need other things. These go into the category of support resistance levels, but you can't just trade off of every support resistance level, otherwise the market could never go anywhere. Markets go through support resistance levels all the time. Sometimes we get stuck between them, but then eventually, boom, they slice through. And that requires some other tools for us to use. So this time it goes up, we put our swing high at 50. Next swing low is at 23. Next swing high is at your 61.8. Next swing low is 23, 68, or 61.8. So you can see that it does provide some good levels for support resistance purposes. Okay, now that is Fibonacci retracements. That's how most people use Fibonacci. Let's talk about another tool that you can use, Fibonacci extensions. So remember, the purpose of Fibonacci retracements are looking for retracement levels to get into a continuation of the trend. So mostly for entries in a retracement of a trend. Now the next tool is Fibonacci extensions. The purpose of this tool is the exact opposite. This one's for exits. So here we've got, again, move down, retracement. Okay, so now if you took this short in the direction of the trend, the question becomes, well, where do I look for profit targets? Where do I think this thing might end? And so now we're in a downtrend again. I'm using just downtrend here, so it's all in the same direction, unique. Your brain can get used to it. And now we're looking for getting out. Where do we want to get out? Now the Fibonacci extension tool, notice it's not going above here all the way back to 100. It's going down. So 100% is not up here, 100% is down there. This is a 3-point drawing tool. That means the way you draw it is you click here, you click there, and you click there, and then it'll automatically plot the Fibonacci ratios below that high. And then these become profit targets. Same percentages, but profit targets. Now, to take it an even further step, because again, you look at those like, well, which one's going to hold, which one isn't. And this is where you've got to read price action, price bars, momentum, volume to see as price comes into these levels, how strong is the move. More likely to break through these levels if it's a strong move, there's strength, there's volume, there's acceleration, nice candlestick patterns. Or if there's not much volume as it comes into it, you start getting little dojis and spinning tops, then it's more likely to hold. But another tool is to use Fibonacci clusters. There's many different ways to use clusters. I'll share with you one today, and that is to simply use the two tools that we already looked at in combination. So we've got our low here, we've got our high here. And so these are the retracements all the way back down to 0. So that's your Fibonacci retracement tool. And then you could also do your Fibonacci extension tool, and that's your 3-point drawing tool. Click, click, click. And now this one draws levels above this low. And now we look for clusters with these two tools. So look right here, for example, 76 on the extension, 38 on the retracement come together. And sure enough, market pause there. As I said, look at these narrow range bars, narrow range real bodies, I should say, and showing some indecision there. So it holds, but also holds because you got 2 Fibonacci levels there. Comes back up, hits here, and again, gets stuck in between these 2 Fibonacci levels. Now, why does that work? What's what I call market logic behind that? All markets are auction places, bid-ask markets. So the reason that a lot of things work in the market is basically self-fulfilling prophecies. You got to figure there's people out there looking at different things. So some might be looking at the Fibonacci retracement, some might be looking at the Fibonacci extension. Now you've got 2 pools of people that are seeing certain levels when they cluster together. Now you got 2 pools of people who are seeing it and are more likely to react to it, buy, sell, take profits, whatever. And so that's why clusters work. There's no magic to it, right? It's all about what are people seeing, what are they reacting to. All right, let's get to a more advanced one now. So this one, very few people use. It's called Fibonacci time extensions. Notice that the lines here are not drawn horizontally. They're drawn vertically. And this is really, really important to have some sort of timing tool in your arsenal. So remember, we can't use Fibonacci retracements or extensions in isolation. We need other things. They're one part of our toolbox, namely support resistance. And think of this too. A chart is a 2-dimensional object. We've got price over here, and down here we've got time. That's all we got to work with, 2 dimensions. Trading's hard enough. So if you ignore, as most people do, the element of time on your chart, which is half the information on the chart of the 2-dimensional object, how can you expect to have a probability scenario? It's amazing to me how few people teach timing anymore, or cycles. And this used to be taught a lot back in the olden days. I'm old, by the way. 62, coming up here in 8 days, I'll be 62. Been trading for a long, long time. My dad was a trader, by the way. So back in those days, I learned about cycles. I learned about timing. I learned about how to use this bottom axis, not only for volume, but for time, how cycles work. And you got to know that because, one of the biggest questions in trading is, when do I get in? So the 2 questions are, where do I get in? That refers to price. What price level do I get in? But then when? At what time do I enter? And so many people totally ignore that to their detriment. So here's one timing tool. There's several. I'll share with you another one. In fact, I've got a timing indicator, a market timing indicator that I'll be happy to give everybody for free. How's that? So I'll give you that in about 15 minutes here. Okay, so the Fibonacci time extensions, the way these work is kind of the same as the Fibonacci extensions we talked about before, but instead of doing it with price, we do it with time. So we start with a cycle low and we go to this swing high. We'll just call them swings for now. So swing low, swing high. And this little diagonal line that shows you, identifies where I started and where I stopped. So there's your 100%. Okay, that's where I draw the tool. So now the tool's usefulness is going to be in the future, and we're looking for times when the market may shift. And again, put in a cycle low or cycle high. So as you notice, once we get to there, boom, market just stops going up. And so we go into a period of consolidation. And if you want to use a different term than cycles, just use period of time. They are synonymous. So we're looking for periods of time. We are in a contracting low volatility cycle right now. When is that going to end? That's the question. When people trade consolidation and they're looking for a breakout up or down, the big question is, well, when is this consolidation going to happen? So there's your 123.6 Fibonacci extension. And that is indicating that around this time, start looking for your breakout. All right, and now again, don't expect the market bars to come into it, right on the line. Markets are a little noisier and messier than that, but this is your period where you would use this along with other things in order to say, okay, get ready, and your mark, get set. And that's what this is. This is the on your mark, get set. The go would be, well, my timing indicator or volume or price bars, that kind of thing. So this is indicating, all right, this could be a time the market shifts and moves up. Again, here, look, 138.2, same ratios, same percentages. And again, within a bar or two, up. Okay, 150, sure enough, that's when we get another shift. With this one, again, another shift, 61.8. Now, let's be very transparent here and identify that, okay, the market made a swing high here, but there was no Fibonacci time extension there. And that's right. Don't expect, I just want to be very realistic with you, that this tool is not going to catch every major swing high and every major swing low. It's just not going to. Nothing does. And that's okay. We don't have to catch every single one. No, nobody does. Warren Buffett doesn't, I don't, you don't, and you never will, and neither will I. But who cares? We're not trying to catch every single swing high and low. That's unrealistic. We're just trying to find some swing highs and swing lows where we can make some money. And that's called making the market come to you. You let the market do all of its stuff, whatever it's going to do, but you've got your rules. And your rules are what rule your trading. And you make the market, you just wait for the market to align with whatever your rules are. And then you take a trade, because your rules are established by a statistical probability. And so you wait and wait and wait. I like to say this phrase, professionals outpatient amateurs. Amateurs tend to trade way too much. And I know this because I used to trade way too much. That was my biggest problem with trading, was I was too impatient and I treated it like a video game. And when I got around professional traders, I realized, oh, wow, these guys don't really take that many trades, not nearly as much as I was trading, but they were making a lot more money than me. So I learned to be patient, frankly. And, some people have asked me what the secret was. The secret for me to become more patient was just the pain of losing money. And I documented all my winners, all my losses, and I realized if I just removed the mistakes I made, where I was impatient and didn't wait for my rules to set up perfectly, I was already making tons of money. But in reality, I hadn't yet, because I kept making those mistakes. So I needed to see that comparison, that if I just kept my rules and only took the trades that were perfectly aligned with my rules, I didn't need anything else. I was already doing great. Okay, so now this tool here is really awesome, because this is a combination. In one tool, we've got time and price measured by Fibonacci. So what this one is, it's called, well, it's got a couple of names, depends on your charting platform. It could be called Fibonacci circles or Fibonacci arcs. They're both the same thing. And the reason they have two different names is because in the viewable section of your chart, it's going to look like an arc, like that. But if you were to change the scaling and scale way out, you will see that they're actually 360-degree circles. So either one, they're both the same. Now, what's cool about this is, again, they measure time and price in one drawing tool. So we go from our high to our low. Again, we always start with that, impulse move, and then it'll draw these out into the future. And that's a cool thing too, right? We got to trade into the unknown future. So it gives us indications of times and prices where we would expect a shift before we get there. Because we're drawing the tool here, and then we lock it in, and it's going to have an arc here, more arcs out into the future. So this one, you look for to go up and up and up and up and ride the arc, and then break away from the arc. And that is the price and the time, using both parts of your two-dimensional object, we literally call a chart, to look for a major shift. Now again, doesn't catch every major move, didn't catch this one. Okay, let it go. Let somebody else make some money. Come on, can't make all the money. Comes back up here. Okay, reaches the next arc. Boom, another major cycle high. Really cool tool. Now, real quickly, I mentioned that you need to use other things other than just, Fibonacci, and in fact, other than just support resistance. Fibonacci is a subset of support resistance. So here are the things that I use. These are the 5 tools that I use putting together as a system. So, and we don't have time to go into depth in it, but I would just, since I mentioned it, I wanted to give you an idea of it. So the very first thing in my system, it's a 5-step system, is I use trend. That's the very first thing I look at, by the way. These are in order of how I look at them. So first I say, okay, what's the direction of the market? Very important. We want to be on the right side of the market and early in a new trend. Number 2, momentum. Now, again, that's the strength of the market move. If we don't have much momentum, we don't expect those support resistance levels to be broken, at least not yet. So looking at it in real time, is there momentum behind that move? If so, then we're probably going to break support resistance. Number 3 is my cycle indicator. This is what helps me time my entries with amazing precision, literally to the penny, pip, or tick. Number 4 is our support resistance. And again, other tools, floor trader pivots, previous swing highs and lows, volume support resistance, and Fibonacci would fit into this as well. And then when I get 1 through 4 all being bullish, then I go to energy number 5. And energy number 5 is what's the energy of momentum on a higher time frame. I like to use a 3-to-1 ratio. So we're using multiple time frames, taking my trades on the short-term time frame, and then 1 through 4. Once those are all bullish, by the way, the key to it is those 5, and I like to call them energies, because they're the energy of money flow. And once I've got all 4 of those bullish, those are all uncorrelated energies, which is why it gives us a probability scenario. Number 5 is my deal breaker. So that's like my filter. I'm not going to go long if momentum on the longer term time frame is bearish. So that would be the ultimate filter. So at each point, I just ask how many energies align. Each get a score of 1 to 5. Higher the score, higher probability of the trade. Like taking each trade to court. We're looking for 5 independent witnesses to establish a preponderance of the evidence. So here's a little bit of what it looks like real quick. Again, we're not going to spend a lot of time on this. Again, I don't use any proprietary indicators. I just use indicators on any charting platform with Top Dog Trading. You don't have to change your charting platform or add any indicators. It's all just basic stuff. And so I just use the 50 SMA as my intermediate trend indicator. All right. By the way, some people say like a lower high and a lower low would be a trend. It could just simply be a complex retrace against the trend. Trends are long-term moves. The dictionary definition of trend is to extend in a general direction. But I'm not just trying to be an English teacher here today. That is financial repercussions because we want big wins and small losses. So a trend trade is one that's meant to give you a big win. Energy number 2 is momentum. Momentum, here's my momentum indicator that I use, higher highs, higher lows, higher highs, higher lows. But then look, lower low on our momentum indicator and lower high. So we also often get these momentum shifts before price reveals them. Momentum and direction are not related. Well, they're related, but they're not perfectly correlated. They're uncorrelated. So this is a strong trend that turns into a weak trend. When it's a weak trend, you want to get out. All right, energy number 3 is cycles. Here's a simple version of my cycle indicator, which I'll share with you. When these highs and lows are going to come in, that we're going to want to trade. Okay, and then support resistance. We've already talked a lot about this. So here's a good example though. So we've got our Fibonacci retracements here. There's our initial move. Okay, 50% retrace. And look, we've got a cluster, 50% retrace and that previous swing high. Then we see that, there's our cycle high. So the time for this up move is done. Our momentum is very weak to the upside. Notice momentum was strong to the downside, which is why it followed through. But when we go up, it's very weak. So there's not enough strength to push through resistance. So we don't expect that it will. And then finally, the fractal energy. Here's my 2-minute chart. And this is my 15 EMA here. That's what I look for the retrace to come in. And we've got our cycle high, momentum is down, trend is down, 1, 2, 3, 4. And then number 5, we go to the energy of momentum in the longer term time frame, and it's down. So that's a 5 out of 5 trade. I take that every day of the week. The method's very robust and adaptable. It works for all markets, all time frames. I personally trade stocks, commodities, options, currencies, futures. I just go wherever the opportunities are. And I do investing, swing trading, and day trading, and I use the same method for all of it. Why? Because all of these tools are really doing is measuring the supply demand in the auction place. Really all comes down to that. And so we've got an objective trading methodology that's universal. So here's my last slide. And this is what I'm giving you today. I actually am not selling anything. Kind of dropped the ball. I know you guys are mad at me for not selling you anything today, so I do apologize for that, but I do have something for free. In fact, several things for free. So what I want to do is give you a trading strategy that works and not charge you for it. I want to prove to you that, hey, Barry can teach me something, can make me some money. Then if you want to buy my courses, great. If you don't, great, totally up to you. But I just figure the best way to do it is to actually give you a trade setup. This is called the rubber band trade, and get you making some money. And you prove it to yourself. Now, in this trade, you're going to get a course that takes you through the trade. And this little course is called Make Money by Breaking Every Trading Rule You Ever Learned. There's 5 20-minute video tutorials in there, including the rubber band trade, interactive quizzes, so you can get feedback loops. And then I mentioned the cycle indicator. I've got a recorded webinar about that. So when you go to rubberbandtrade.com, that's the URL, rubberbandtrade.com. Yep, got it there already, thank you. And that's where you get all of this. Once you go there and fill out the little form, you will be emailed the URL for the cycle indicator webinar. You can, like I said, it's recorded, so you can watch it anytime you want, wherever you are in the world, whatever's convenient for you. And you get the mini course that includes the rubber band trade. So that's it for me. Let's open it up for any questions.
Dun, dun, dun. All right, let me scroll up here. Oh, wait a minute now. I think we have a few for you.
Okay, goody.
Maybe, do I have it scrolling the right way? I have, what is a free charting program with Fibonacci tools from Carrie?
Oh, let's see, free. Well, I think there's several. I believe TradingView, their free version, I believe that has Fibonacci tools on it, if I recall correctly. Let's see, I think there's one called, I'm not really too familiar with the free stuff anymore. But
Dan says MT4 has FIBO.
Okay.
And B. Lloyd wants to know how to determine where your swing high and low is.
Okay, so that's a great question. So that's where the cycle indicator comes in. Yeah, that'll identify your swing highs and swing lows. I mean, you can do it many different ways. That's how I do it. Other people do it more subjectively. They just eyeball it and look for major swing highs and lows that stand out on the chart to them. But I have a more objective way of doing it, so I use my cycle indicator.
Cool. And Michael wants to know, does this work on option price charts?
I don't personally like using option price charts, so I do this on the chart of the underlying itself.
Okay. All right. Dennis says your website will not allow me to submit. Dennis, you may just need to wait until Barry sends you the email, and then you can just click on the link, I think. And B. Lloyd came back saying, does your cycle indicator fixed? Can you change numbers within the indicator? Okay, Dennis did get in, so we're good on that. But
yeah, I think. I'm sorry to interrupt, but on that one, yeah, I think that is a issue with some browsers because the form is a pop-up, but I believe, so we ran into that before, but now what we've added, if you scroll down, there should be an embedded form there so that you don't, if you have a pop-up blocker, you don't have to worry about it anymore.
This pop-up was blocked. Yep.
Yeah.
So we're good on that. So with this question here, I'm not sure I'm reading it right. Does your cycle indicator fixed? Can you change numbers within the indicator? Does that, I may need that retyped. I'm not getting it.
Yeah, I know what they mean. Yeah, you can change them. Again, this is not really an indicator that you have to download or import. It's a common indicator on every charting platform, but we do modify it. So,
all right.
Yeah, so anyway, the answer to the question is yes, absolutely. You can change the numbers. In fact, we do change the numbers, and I give you all that information in the webinar on exactly how to do that.
Okay, awesome. Okay, guys, I have put Barry's email in the chat. I've also put the link to rubberbandtrade.com so you can go and get that free course and a free trade strategy. And there is a pre-recorded webinar there so you can see the cycle indicator. So I just we need to move on. We're getting close to the end here. We got one more great speaker coming up. Barry, thank you so much for coming back and being with us again, and I'm going to look forward to seeing you again and again.
Well, good. Thank you so much. I appreciate it. And thank you for putting on such a great event. Many great speakers.
Thank you. Today. Have a great day, and we'll see you soon.
Okay.
Thanks. Bye-bye. All right. So again, this presentation is sponsored by Market Taker Mentoring, Dan Passarelli. He's got a webinar coming up tonight at 7 p.m. Central, 8 p.m. Eastern, how earnings trading can be your most profitable trade. He's at markettaker.com/earnings. And our next speaker is coming up, and it is a real treat to have her with us. It's Marina Villatoro of the Trader Chick, and she's going to talk to us about 4 steps to simplify your day trading. And Marina is the Trader Chick. She specializes in helping people to day trade with confidence and ease, and she simplifies the process of completely breaking down the art of identifying high probability trade setups. Even if you're just getting started, you can learn to day trade profitably and read the markets like a pro. You'll be amazed at how simple it can be. Now I'm looking at my list here and I don't see that Marina has logged in yet. So you guys may be stuck with me for just a minute until I figure out where we have hidden Marina. So, well, let's see. I mean, worst case scenario, we may be done if there were extenuating circumstances. So I'm going to stop sharing my screen so that I can figure out what we're doing. If you guys have any questions about anything, please type them into the questions box and I'll do my best. Oh, if you have a favorite trader that you would like to see come on to the Traders Exclusive webinars for an event like this, please put their name into the chat so I can get in touch with them. And then that way we can keep this really super diversified and ready to go. I'm gonna see if I can locate someone. Okay. So let's see if we've gotten anything here. I still have 3 gentlemen in as panelists. We may have to do some question and answer Or if everybody's ready to go offline, we may miss out on Marina today. I'm not sure what we're doing here, so stick with me. I'll be right back. Folks, hold on with me for just another 2 minutes and we'll have a determination if this webinar is over or not. And I apologize for the wait here. Marina, can you hear me and can you speak?
Yes, hello. I've been here for 30 minutes
Yay.
writing.
Okay, you joined with a registration link instead of your panelist link.
Oh, that was good.
Everybody, she's here. She's been here all along. Yay! And with all that said, I already did your introduction. You probably heard it.
I heard
And you
everything.
can take it away.
Okay.
Thank you.
Great. Hi, everybody. Yeah, I didn't have the panelist link. I guess I only had the one that was sent to me via email. But I'm happy that everything is on and we are all here. And thanks for all you guys who waited. I appreciate that. And thank you so much, Sherry, for having me. Okay, well, like Sherry introduced me, I am Marina Villatoro, the trader chick. And today I want to talk about 4 steps to simplify your day trading and dominate the market under any condition. So hello, I am Marina, the trader chick. And I just want to do a really quick intro. This is me, Marina. I am, excuse me, I am an expat living in Antigua, Guatemala. I have been living here for quite some time. My husband is Guatemalan. These are my kids. Also, I am trilingual. And the reason why I bring this up is, first of all, a lot of times people get lost in the idea that trading is only the charts, but we are humans and our life experiences and who we are bring us to whatever we do. And I think understanding that we are not, I don't even want to say 3-dimension, 4-dimension, that it's good to know who people are and, you know, and the chemistry and everything, because that makes everything so much different. And I like to bring up the fact that I'm trilingual simply because one thing that I noticed after struggling with the markets for such a long time is that understanding the market is literally a new language. And I speak 3 languages. I speak Russian fluently. I am actually a refugee from the Soviet Union over 40 years ago. And so Russian is my mother language. English is I call it my native language because I was raised in the US. So English to me is the most natural. But I've also been living in Central America for almost 20 years. So I also speak Spanish fluently. And Spanish was the language that I learned later on in years. And if any of you have ever learned a new language, especially in your older years, you'll understand that there's a process, right? It took me almost a year to be really, really committed and learning to the language. And every time I did anything beforehand, I had to first translate it in my head, process it, and then say it out loud. Then once somebody responded, I had to first translate it in my head. It was just a long, long process. Gratefully, there was a lot of people that were patient with me. But then one day I woke up and I simply knew how to speak. It just knew, like there was no translation going on. It just happened. I'm not 100% fluent, but it's just clicked. And when after really sitting around and watching the markets for such a long time and studying the charts, I realized that one day it clicked for me and the market actually speaks to us as well. And when you start to understand it, that is when you could actually start to work with the market rather than pretend that we could beat the market or predict what the market is going to tell us or what the market should be doing. Because in reality, it's kind of like, you know, when they say when you're speaking to somebody and you're not actually listening to what that person is speaking, but you're too focused on what you want to say next, that you miss the whole conversation. It's the same thing with the market. If we sit and listen to it, we'll understand it. But if we want to push something on it that isn't going to flow, it's going to backfire at us. So another thing, before I became a day trader, I was actually a fitness instructor and a travel writer. And the reason why I bring this up is specifically important because so many people come to me like, oh my gosh, I don't know how to read, I don't understand math, I don't have an economic background, I don't have a financial background. It doesn't matter, because that's the beauty of day trading. Anyone can do it, and that's the beauty of it. So before I was actually a day trader, I am to this point still a travel writer. I have this travel site that is still active. Obviously, this year we've kind of been benched and not traveling like we normally do. But I do talk about that all the time. And day trading, the beauty of it is that it works so well with my travel lifestyle. And that's the beauty of it. So before I jump into the actual presentation, I have a free free worksheet for you that I would like for you to use and follow along with this presentation. So go right here, makingofadaytrader.com, and you will automatically get this document completely free. And it's a cool presentation. It's also literally what I use when I trade. So you'll be able to apply it and hopefully implement it for your trading as well. Makingofadaytrader.com. Okay, so what are the basics of trading? Just like any language you'll ever learn, you have to start with the basics. You start with the hellos, the goodbyes, the how are yous. It's basic stuff, right? And then you grow from there. So if you don't have the basics of the market, you'll never be able to do the hard things, right? And that's what I really want to focus on. It's understanding those basics. Before we go into anything though, for day trading, it's kind of like if you want to learn how to play an instrument, you can't just start banging away at drums without a drum set. You can't start playing a piano without the piano. if you want to be a day trader, you need a platform. It does not matter what your platform is, but it has to be a good, solid platform where you get live feed, where you're able to draw on it, where you're able to put any indicators you need. Otherwise, that isn't trading. That is maybe investing. I think maybe you could probably even pull it off with swing trading, but for day trading, you really need that platform. You cannot be a Formula One driver without a car. Okay, so it's the same for trading. And indicators. I started about 9 years ago, and I had 1,000 indicators to the point where it literally drove me into massive analysis paralysis. I had a massive breakdown, and when I came back, I decided to only go with bare naked charts, right? Just the price action. But after a little while, I recognized that you really do need some indicators to really help you understand if the market is going in one direction, in another direction, and the strength. So I've narrowed it down to 2 indicators that I use now, and they are EMA lines and the MACDs. Those are my 2 favorite, and they are simple, and the beauty of them, they are completely universal and free on any platform, any platform that you choose, right? Paid or free. Although if you're really serious about this as something you want to do, you will go for a paid platform simply because it's much more reliable, especially when you start to take live trades. Okay, so we're going to start with market movement and the breakdown of a trend. We all know that there are 3 trends, right? We know that. We understand that there is an upward trend, we understand that there is a downward trend, and we understand that there is a sideways trend, right? So a sideways trend actually is probably the most difficult to fully understand. Why is that? Because this is where people end up losing the majority of their money. And even though even though it is a trend, it's also a very complicated one. And we have to be able to understand and recognize when we see this kind of a trend. Okay, so again, it's really important to understand the concept of trending markets. And the reason why is it's kind of like getting into a car and going on the wrong side of the road, right? You have to understand that you drive on this side of the road and you turn to the right rather than left when you have to turn the right. It's confusing, right? But a lot of people don't understand that if you're having a downward trend, first of all, traders short and long the market equally. As a matter of fact, I think most traders probably make more money shorting the market. So it's not about sitting and waiting only for the market to go long, because you might miss the majority of the really great setups. So understanding that you could do on both mirror image as long as your technical analysis is working is perfect. So obviously a an upward trend is each pivot is higher than the other pivot, right? It's pretty easy to understand. It's called the bull market. It's called market trending up, market going up. This is when you go for the longs. This is when you buy at a lower price and you exit at a higher price, right? You're going long, okay? Now, downward trend, identical, only your pivots are lower than the other pivot, right? Each pivot is lower than the other pivot. So what is this? It's when you're shorting the market, when you are entering the market at a higher price and exiting at a lower price, and you're taking the profit in between, right? So you're shorting the market, you're going short. It's the market trending down. It's a bear market. Even though it's called a bear market, it's still a very moving market, right? It's not hibernating. So it's important to be able to understand that it's fun to go into that kind of a market. There's also 2 different, there could be a mini momentum in between. For instance, the overall might be going up, but you can get in, especially if you are looking for really quick profits. And I personally am a scalper. So for me, immediate momentums are awesome because I can really monetize on this quick mini trend before it decides to fail and continue in the overall momentum, which in this case would be going up. Okay, so understanding sideways markets. It's literally a trader's worst enemy. And I can guarantee you right now, if you guys go back into your, however you guys keep track of your trades, either a journal or Excel, your back testing system, you will recognize that 90% of your losses usually happen during the sideways markets, which is also can be called a consolidation area, an indecision area, an exhaustion pattern, the chop. I mean, there are thousands of different names you could give to the same thing that's happening, right? A channeling market, consolidated market, it does not matter. The important thing to understand is that it is where you are stuck and it's not going anywhere. Okay, so it's between here and it is consolidating, meaning that it's an indecision area. So why is this area literally the most, I guess, how can I say it, like besides being the enemy, the most losses that a trader goes through? Here's the reason why. Day trading is an emotional mindset activity. No matter how you look at it, the reality is 85% of day trading is how you handle it emotionally and mentally. Okay, so it's really important to understand that. We humans love to do stories. We love to tell stories. What does that mean? Here's an example of a story. My friend or somebody that I kind of know called me up and invited me to their party. I don't really know them yet, so it's kind of like a new friendship, and I'm excited about the party. And she said, oh, I'll call you back tomorrow to give you the information. Tomorrow comes and goes, and she doesn't call me. The day comes, the next day, and again, she doesn't call me. So I come up with stories. I tell myself, okay, maybe she doesn't like me. Did I say something wrong? Oh my God, I wonder why. What did I do? And you put yourself into this negative state of mind, correct? Only to find out 2 days later, she calls me up, apologizing left and right. She's like, oh my God, my phone fell into the bathroom and I didn't know I didn't know how to contact you any other way. So I came up with a completely false story because that's what humans do. Consolidating areas are the death of our stories because what happens here? When we have an uptrending or downtrending, it does not matter. And for this sake, it would be the uptrending market. And we come up to this indecisive area. There are two types of traders out there, and you will be qualified. You can classify yourself with one of those two. There are no others. There's two types. One is the trend is your friend type of a trader. In this case, they believe, okay, so the market has been going up all day. I'm going to continue going long because it's consolidating, but I know it's going to continue because the trend has been going up all day. The other kind of trader is the contrarian trader. And I actually am a contrarian trader, but I stopped with my stories. What the contrarian trader is like, okay, you know what? It's been going up all day. It's got to correct. It's got to correct because it's just too much going up. So I'm going to go short. Here's the reality. Those are two stories, and that's all they are. They are completely not true because what's happening is it's consolidating, and the market could do what the market is going to do, and it could go either way. And we, as individual retail traders, have absolutely no idea if it's going to go up or down. All right. So what we have to do is understand that this is a consolidating market, and we need to sit out, which is a very important activity to do, is to sit on your hands and wait until it gives us confirmation. Now, the important thing is understanding when does this happen, because you can get into the first trade when the consolidated market simply begins and you get stopped out. And that makes sense, right? Because it's the very first beginning. But when you do get stopped out, you have to sit back and look back and start to understand what is really happening. But there are actual ways to avoid being stopped out altogether. And that's what I want to also show you, because it's actually quite simple. So I'm showing you the different types of consolidations. It could be mini ones, it could be larger ones, right? And it could happen quite often in the same trend. But if you don't recognize them, you could miss out on so many awesome trades, on a new trend trade, on that mini immediate momentum trade, on a breakout trade. There's all these trades, but if you don't recognize it, you'll only be getting into the losing trades. Okay? So understanding all of this, how does this work? Look, the market loves and respects areas. And we, as the individual retail trader who will have absolutely no control over any of the market at all, unless you guys are going in with millions of dollars, chances of you moving the market anyway isn't going to happen. So we have to work with the market. So what are these areas that we need to respect them? They are support and resistance areas, okay? To me, support and resistance areas are literally like the safety belts when you get in the car. You get in your car and your kid is in the back seat. Are you gonna just let them hang out like that? No, chances are you're gonna tell them to put on their safety belt, and you're gonna put on your safety belt. Resistance and support areas are your safety belts, because if a market is respecting an area, you have to respect it as well. And the way that works is you have to understand where is that area. So what is a resistance area? Pretty simple. Resistance area is literally the ceiling of the market. That's all it is. It's where an area is hit 3 and more times. Anything less than 3 times, I wouldn't really call it an area just yet. But anything over 3 or more times, and the more times you have it, the stronger that area is. That's when you have to understand that maybe it gets stuck there. And it doesn't matter if you have massive strength, it could get stuck there, it could hit that brick wall. So you don't want to be going into those trades where you see those resistance areas, okay? So this is what a resistance area is. Sometimes it could last for days, sometimes it could last for hours, but you have to understand where it is. And if you're planning on going into a long and it's been an area, I wouldn't risk it. And I definitely wouldn't be, you know, egotistical enough to say that it's going to break here, because that is simply lying to yourself, and that's where the story starts to go against you. Okay, this is what resistance area looks like. And what is a support area? It's literally the floor of the market. It's literally the floor of the market. It's where it hits that market, the floor. It's where it's hitting it. Okay, and it can stop the trend. And again, it's got to be 3 or more times to hit that area. And in this case, if it's hitting it over and over again, that is the floor of that area, and you need to respect it. And it could be strong enough to completely change that direction. And you want to be on the right side of the market all the time. Okay, and that's literally respecting those areas. So again, it could be in the channel, support and resistance. These are all areas that we really, really need to understand and respect. This is a channel. It's not a tradable channel. Look how ugly all these bar movements are, right? They're kind of choppy. It's not pretty. This is choppy, ugly, sideways movement. But it is shown to us really clearly with the support and resistance areas. And this is something that everyone really, really needs to understand. Here is an area that's been respected. Even with all the strength, it still came to that end, okay? So that's what these areas are. Now, how do we recognize when these areas are just starting to happen, right? And that is really, really important. That is what I call reversal patterns, the telltale signs. These are the most important, and they're free indications, and they will literally, I can guarantee you, save you thousands and thousands of dollars if you simply understand and listen to when the market is showing them to us. And and the market shows them all the time. And if you understand it, you'll be able to know that there is weakness in the market. There is a very high probability that the market is going to shift. And when you couple that with, hang on one second, sorry. So reversal patterns, right? What are reversal patterns? Triple tops, double tops, triple bottoms, double bottoms, head and shoulders, right? And when you couple that with divergence, that is the golden sign. It is literally the golden language of the market. It is screaming to you, do not continue entering me, because right now I can shift. And that's where you really don't want to be, right? You do not want to be in a market that is ready to shift going in the opposite direction. So what is divergence? As you can see here, there are pivots, right? This is a perfect, beautiful double bottom. And the MACDs, you can see, has also pivots. And the MACDs is probably the least lagging indicator that you will have, meaning the majority of indicators before that, they all lag, right? They all lag a little bit. So I found that the MACDs is the least lagging. It is starting to tell me with divergences, with when it gets closer to the zero line, that is slowing down, that is losing its strength in that area. And that's why I want to stay away from it, right? So again, double bottom, massive divergence. You can actually start to spot divergence even without the reversal patterns, but when you have reversal pattern and the divergence, stay out. Stay out because it will save you so much. All right, let's put all of this together. But remember, first, download makingofadaytrader.com. This is your cheat sheet, the whole presentation that I am literally going through here. So please download this right here. The whole presentation is completely free, makingofadaytrader.com. All right, breaking out of an area, how to spot a valid breakout. We all know about breakouts. We've all heard about breakouts, right? They are probably they're probably some of the best trades that you could take. However, if you do not understand where is the support and the resistance area, how are you supposed to spot a breakout, right? So an easy way for me to explain a breakout is like this. It's just really quick layman's terms. You just got a call from one of your friends and they invite you to go to their house. You've been to your friend's house 1,000 times. So you could do it with your eyes closed pretty much. All you know is you got to go straight on the highway north. So you hop in your car, you get in the car and you're full of confidence. You know where you're going, but all of a sudden there is a construction site and the road is closed, right? So what happens when the road is closed? You have to make a detour. So you start to stress out. At least I do. I start to stress out. I get worried. I'm like, is there a detour going to take me to the highway again? Where's the detour going to take me? Are they going to continue with the detour signs? I've been on some detours where they stop the signs and I'm totally lost in a neighborhood I've never been in. So I start to freak out. I start to be in complete doubt, totally worried, right? But all of a sudden, the road opens up and the construction guy puts you right back on the highway and you are full of confidence and you are continuing on. That is that breakout. It's literally going in the same direction. That's a breakout trade, right? You're going north, detour. So what is the detour? The detour is that consolidation area, that indecision area. You could be totally turned back. They could tell you, you know what, there's a hole in the road. You got to go back. So while you're in that indecision area, in that doubtful detour, you don't want to be taking any trades. But once they open that road, you're totally back where you know you're at, and that's where you could take all the trades, right? Here it is. This is what a breakout looks like. The breakout trade setup. This is probably the most powerful trade you could possibly ever be in. But if you don't know if there's a resistance or a support area, because you could do either one, if there's a massive strength in the MACDs, right here, right way above the zero line, no divergences, how can you possibly take that kind of a trade, right? Hang on a moment here. So Paul, it would be nice to have a company that sets up screens on a custom one-on-one basis. Well, there might be, but I wouldn't pay somebody to do that. It's kind of like telling, what you're saying right now is, it would be really cool if somebody could sit in my car and set up my, put it in first gear for me and press on the clutch and you hop in. No, you want to be in complete control of everything you do. And trust me, once you learn how to do it, it literally takes 30 seconds. So I would recommend just going for it and learning yourself. It's not complicated at all. All right, so bonus setup. I call this the initial instant reaction trade. What is this? It's understanding when the market has shifted and transitioned into a new trend, and you get in at the very first hit of that trend. And that's understanding when it crosses over. It's understanding the confirmation. It's understanding the MACDs. And that is all done through reading the market. Okay, so once again, guys, all of this that I just went through is in makingofadaytrader.com. Okay, get it here, makingofadaytrader.com. And now what I want to do is I really would like to go in really quickly into the live market just for you guys to kind of get an idea of what the live market is and what it looks like. So I personally am an ES Mini futures trader. This is a Ninja Trader platform, and this is the futures market. So how do I use the, as you can see, this is my charts from today. Even though it was inauguration day, it was a very volatile, beautifully moving day. So you could see that for me, the resistance areas, in this case, there was really very little support areas today. It was just a booming market going up. However, look at these beautiful immediate momentums, right? There's like awesome trades going down, going up, heading up, even going down here. So understanding where all of these can happen, hang on just one second, I wanna make it like that. Understanding where to enter, going down, understanding with the MACDs. This isn't difficult because it's two indicators only, right? And when you understand that and understand how to use this here, I use this particular indicator as a support area at times so that I would know when it is indecision area. All of this can be learned simply by reading what the market is telling you. And that's the coolest part of it all, right? And it doesn't take much. All you have to do is simply listen to what it says, watch the market, watch the movement, and there are tons and tons of trades constantly coming up, right? So this is the ES Mini, even though it is after the market closed, it is open almost 24 hours a day, and that's the beauty of it. You could trade it for 6 days out of the week. On Saturdays, they are closed for maintenance day. Okay, so this is, I just wanted to show you guys, oops, hang on a second here, where am I? I wanted to show you guys what the live market actually looks like, and so that you guys could get a really good feel of it. Now, wasn't that fun? Imagine if we could do this together every single week, go through all of the different areas, understanding reversals, understanding where the entry points are, understanding the breakouts, because I am so excited about this part of the presentation, because right here is what most traders can do to unlock what is holding them back. And do you guys know what that is? Do you guys know what that is? It's understanding how do you even know if you're doing it right. So I have found that so many traders, especially people that come to me, they have been watching YouTube videos, reading all these books, and trying to go into the market, basically self-educating, only to not know how, if they're even doing it right, like if that is the right steps that they're taking, right? So let me break it down to you. I've made something that is really special. Really, when you get the cheat sheet, you immediately get put on an exclusive VIP list. And I want to encourage you to get this free cheat sheet right now. That is the same thing as getting the presentation with you, and that you'll be able to completely go over it. And I'm pretty sure Sherry is going to be sending you guys all the replays so you can go over it and understand a lot better in the live market. And I want to encourage you to get this cheat sheet, okay, and be put on that VIP list, because this could literally be the turning point for you. This is a special invite coming directly into your inbox, and only comes to the people who are on this presentation live. Only for the live people on this presentation. Nobody else is going to get this. Okay, so remember, makingofaDayTrader.com. And here is what I have for you. So many of you guys have asked me during and after the presentations if I have a program. And I usually hold back because I don't want you to buy just another product. However, I have created something really, really special, and it's called Simplifying Day Trading Futures course. It is my signature course with short, bite-sized videos and explanations that literally show you what I do every time I sit down and trade. And you could do it from any device. If you are on your phone, on your computer, on your laptop, iPad, you will be in essence with me side by side. But again, I could only make the special invite to people who get the cheat sheet at makingofaDayTrader.com. So make sure you go to that link and subscribe right now while you are live. And I don't want to just give you the information. I want to sit next to you, with you, as a special for the participants. Only I'm giving 6 months, 1-to-1 membership. This is only for the live participants. Nobody else is going to get this. So remember, go to makingofadaytrader.com. There you will get your cheat sheet that automatically registers you to be on the special list. But only the people who register for the cheat sheet, and only the people at this presentation. And on top of the 6 months of working one-on-one with me, I am giving you guys an extra bonus. I have a live trade chat room, and you will get 6 months for free membership into this live chat room, where I am live with you, analyzing in the live market and taking trades live with you, watching and understanding. Not only do you get me mentoring you for 6 months, but you also get 6 months free membership into the live chat room. This isn't like me hiring a bunch of moderators, because I know that a lot of chat rooms have that, they're moderators. No, it's me live implementing everything I teach you, watching and asking me questions and implementing alongside with me. The only way to get on this is, again, to sign up for this cheat sheet right now, because the program and all that I offer is so robust. With so much information, I'm giving everyone lifetime curriculum access, unlimited access to it. Now, I'm not going to release the price because I want to surprise and delight you with how value driven this is. However, what I will say is that it's literally less than the average of one trade, and that is a fact. So go back to makingofadaytrader.com and be notified. It's literally less than the average trade. But as with everything, there is a catch. So here is the thing. I only have space for 25 students. Due to the one-on-one mentorship, I'm only able to take on 25 new students at this time, so that you can get my full attention and commit to your day trading. The goal for me is to commit to your day trading. So I really cannot manage more than 25 people. Okay, so remember, when you get the free cheat sheet, you get put on the VIP list and are eligible for the 6 months one-on-one mentorship and 6 months live trade chat room. And you get lifetime access to the curriculum of Simplifying Day Trading Futures course. So if you haven't gotten the cheat sheet, go here right now, makingofadaytrader.com. Okay, makingofadaytrader.com. And I think you guys have some questions, so please let me know any questions that you have. And I think, Sherry, you will also have some questions usually. Again, guys, I really appreciate you being here. Thank you so much.
All right, so I posted the link to Marina's offer there, and it's makingofadaytrader.com. If you look in your chat, it should have gone to everyone a couple of times. Now, Marina, do you want them to have your email address in case anybody's got questions afterwards?
Sure, you could definitely email me, and it's thetraderchick@gmail.com, or you could just go to thetraderchick.com and you can find, excuse me, everything there.
Okay. And then I have a question here. What are these candles called? I'm not familiar with them. Used to Japanese ones from Paul.
Oh, okay. Hang on a second. Oh, there we go. So let me go back to the candles that I'm using here. They are actually tick bars. You know what? It might be easier to show me
tick
here.
bars.
So they are, I use now candlesticks, but those particular ones, they're literally the same thing. Only what I use is called a tick bar because I use a tick chart. So if you guys notice, there is no volume on my charts because these bars are tick chart from tick bars, meaning that they are, I use a 610 tick chart. So this is my volume. You can see right here where it says ticks remaining. Each bar shows the amount of transactions that are happening in the moment. Because with a volume indicator, like I said, it's lagging. You will never know what's happening in real time in the moment. So those bars, basically that little ball is exactly like a candle. Cool. It just ends where the price ends. That's the only difference, but I use tick bars. And it's just, you can see it, it's awesome. exactly how
Yeah.
many people are in the market, and it's super volatile.
Oh,
People are very
nice.
excited.
And also, B. Lloyd asked, what are the blue lines on your MACD used for?
Okay, so I love to know where the strength is. The 0 line, it's part of the MACDs. I put in these blue ones myself. It shows me where there is strength. Once it hits the first blue line and then the second one, I know it's confirmation for me that there is massive strength in the market.
Wow.
And the same here. It's showing massive strength in the market if it's going up, and if there's no divergence, that is showing me when it retraces to my indicator that I could get into that particular trade. That's a really strong trade. So that's basically, it's just something for me to show me that there's strength and confirmation.
All right. Oh my goodness. Okay, everybody. Anybody got a couple of last minute questions? And we're going to wrap it up. It's 3:59 p.m. Eastern time, 2:59 Central time. So we're just right on. You guys always amaze and delight me when your presentation is exactly the right length, have a time for a little bit of talk, and you can get your offer out there. And remember, everybody, you'll be getting email after this, and Marina, you're going to send them an email with this offer in it, something similar to it, to follow up.
Oh, yes. If you guys send me the making of a day trader, and once, yes, thank you.
Okay. All right, cool. All right. Thank you so much for being with us. It's
Thank you, Sherry, for having me.
I don't see any more questions, but they've got they know how to get in touch with you, and then if you're back in touch with them, you'll have that as well. So thank you so much for being with us again, and I look forward to having you back.
I will definitely, and thank you, and sorry for the issue in the beginning.
Oh,
But thanks for being patient.
I gotta tell, okay, I'm gonna confess, everybody, it was my fault. Somehow Marina's panelist join link got erased out of her emails. So that was definitely on me. So thank you for persevering, and thank you for hanging in there while we figured that out.
Thank you.
So,
Okay, well, have
all
a
right.
great day and talk to you soon. Bye,
All
everybody.
right, thanks so much. All right, everybody. I just want to remind you that we are going to have this presentation was sponsored by Dan Passarelli at Market Taker Mentoring. He's going to have a bonus webinar tonight, 7 p.m. Central, 8 p.m. Eastern. How earnings tradings can be your most profitable trade. It's real simple. markettaker.com/earnings. This webinar is going to be uploaded to tradersexclusive.com, and you can't see it in the underline there, but it in the, because there's an underline through the whole link, but it's tradersexclusive.com/archived_webinars. So we hope you'll go there and you'll avail yourself of that. And finally, I'd just like to thank our presenters for being with us today. It was awesome, and thank everybody for attending. This is your host, Sherry, and I'm just wishing and saying trade well, everybody. Bye-bye now.